There we go. Okay, there we go. I think that's okay. Everyone see that okay?
Yep.
All right. So we'll just go back one. So, okay, good morning, everybody, and delighted to have you here. Your colleague will join us presently. Just from a housekeeping point of view, you can put your phones on mute, and equally, if you can put yourselves on mute as well. Although, having said that, we're a small audience. If you have any questions, given the scale of it, feel free to ask me during the course of the conversation. Or what I would suggest to you, and what I suggest to people is, and again at the end, but sometimes people can percolate on these things for a day or two afterwards, and or a week indeed. So feel free to come back to me with an email if you have any specific questions that kind of occur to you after the event. Okay. So I suppose briefly to mention what we're going to talk about here is the evolution of company law in the Irish context. We're going to highlight some of the consolidations and amendments that were recently brought through in the most recent iteration, which would have been the Companies Act 2014. That is the code which we operate under here. There are a number of other codes which I will touch on, and which I would suggest you're not bad from I suppose, a reading perspective. They are easy to read. They're standards that have become common practice across the jurisdiction. The two primary ones, which we'll touch on briefly, would be the Charities Act, and that has huge implications in the Irish spectrum, and again, the state codes as well. And I really just want to emphasize the importance of understanding these regulations for your own, I suppose, effective corporate governance of your own organization. And again, I would say at the outset, transparency is important, but it's about reputational management as well, and mitigating reputational risk. And where you often find kind of issues arising in terms of the corporate governance space is that people just don't know the rules of engagement, and they haven't given it due consideration. And it's sure it's always been done like this around here, and it's been fine. And that can be very well the case until things aren't fine, and then it all gets very sticky. So that's why corporate governance exists, to kind of navigate, to allow you to navigate through those kind of situations when and if they arise. And what we're going to cover today is really the rules of engagement, such as they are at the moment, and they are evolving the whole time. It's a Camino, if you will, of governance at the moment. Look at the key roles and descriptions and responsibilities. Have a look at directors' duties under the law, and what best practice looks like in terms of that space. And there is I suppose, that separation in your own mind of being an executive director and then a director of the organization. They're two separate kind of issues, and sometimes that can cause some challenges from people's mind. Key relationships within the board and how that looks and how that works. And then just have a walk through the legal and regulatory frameworks that we're operating within the moment. And hopefully I would suggest, at the end of it, you'd have a reasonable understanding of the principles of corporate governance in the Irish context, but equally more kind of more globally as well. You should have a reasonable understanding of your duties and responsibilities. Hopefully recognize what an effective board from your perspective might look like at Pinnacle, a healthy board, a functioning board, and how you can add value in that space. Know why it matters, ultimately why you're doing this and the raison d'etre for it, and hopefully have a little bit better kind of equipment in your armory to navigate board meetings competently. And really what people want from a board is efficacy. They want efficiency. They want to use their time to the best purpose. And again, that's one of the things that we'll touch on. One of the other areas that we get a huge amount of questions on are conflicts of interest, and I'll touch on that as well. Okay, so here we go. What is corporate governance? How did we get to this? And we've had codes of conduct and governance with us from the early days of the Bible. We often use probably the first codes the people would be generally familiar with, although not necessarily the first codes. Would be the Ten Commandments as a case in point in terms of rules of engagement. There was the Rosetta Stone before that, but so people have always had rules and regulations and so on to operate by and operate within. And within the context of business, corporate governance is I suppose, the byword that we use in terms of outlining what it is. And it's about direction and control. It's about procedures and processes and attitudes as well, by which your organizations are directed and controlled. And again, it's the duty and responsibility of you as directors to put in place those systems and processes to ensure that the organization achieves and sustains its purpose and the objectives with integrity. and is managed in an effective, efficient, accountable, and transparent manner. And again, it's kind of, I suppose, that byword is the best use of your resources and to trade profitably and effectively and efficiently, and have a look at kind of shareholder value in terms of, I suppose, alignment with your strategic plans, such as you have them in place and review them on a regular basis, and that the company has been ran on a probate basis. And again, another kind of metric of that is that piece from the central bank recently, 2018. I use the term recent in their perspective. They tend to be kind of a little bit more measured in terms of their pronouncements, but they actually just defined it as the procedures, processes, and attitudes by which an organization is directed and controlled. That's our own central bank, and it's actually not a bad way of looking at it. And it is really about the way that the companies are directed and controlled. That's what it's all about. And you are now the controllers in this perspective. And I suppose it's an attitude as well. You need to kind of be aware that there is a separation from executive management and non-executive directorship. And even if you are an executive director, which you are, when you're at a board meeting, you need to just think a little bit differently. And I would say the big lesson that we see out there is that people need to put on a strategic hat when they're sitting at the board, as opposed to a tactical hat. And what I mean by that, for example, is that, and I've sat on both sides of the table here. Generally, as managers, you're looking at day-to-day tasks, rolling tasks. You're tactical. You're very much in the now. You're looking at firefighting. You're juggling a lot of issues. They're coming at you, and you're dealing with kind of trying to deliver on projects and stuff like that. As a director and a board, you need to step back a little bit from that. Now, for sure, you need to be looking in the rearview mirror at what happened over the last quarter and get your reports and stuff like that. But you are charged to be looking out 6 months, a year, 3 years out strategically, and navigating towards what the future holds and mitigating risk in that area. And that actually is probably not a bad way of looking at it. When you're sitting at the boardroom, you need to be looking out manifestly more so than looking in the rearview mirror. And we'll touch on that in a little while. There is a ratio there. I don't necessarily agree with it, but there is a ratio that you should be 80% forward looking and 20% rear view mirror in terms of the time spent on board. I've never actually seen that work in practice, to be honest with you. I think you'd be doing well if you have 50-50 in terms of the split of how you apportion your time at the boardroom table. But whatever it is, there should be a significant amount of time looking out towards the future as opposed to reflecting on the past. And that is the difference between management meetings and board meetings, if you want to crystallize it in your mind in terms of, I suppose, the split there. Now, there are, for example, I mentioned the charities regulator, and they're quite good in terms of some of their documentation. And I would often say to people, against ourselves, have a look at the charities regulator website. We've got some very good user-friendly documentation out there that you can dip into in terms of, I suppose, best practice in corporate governance. And if you think about it, since they came in September 2021, that regulation vested, you've got over 11,700 charities registered in the Republic. And when you think about the Republic as the same population as Greater Manchester, that's an extraordinary charity operational footprint. And you've got a population of over 71,000 citizens now who are registered trustees on charities. So that whole population has suddenly become very interested and aware of corporate governance like never before. So again, there is a movement for education in the space, and the charities regulator as a touch point isn't a bad one for, even for regular kind of operational companies, just to take a look at their stuff on a not just dip in every now and then, or go on their newsletter, because they do have some very good stuff on corporate governance, which is very user friendly. And they operate on 6 principles of governance, which again, I have to say, encompass a lot of what we'll be talking about. It's advancing your purpose. If you forget about the charity piece, it's advancing your purpose. So that is really what your strategy is in terms of Pinnacle over the next 3 to 5 years. What have you laid out as your purpose, your strategy? So really, you should be focused on advancing your purpose. It's about behaving with integrity. And it goes without being said, but it's worth saying it as well, that you have to be mindful and respectful of people around the table. You have to operate ethically. You have to allow people to get their spoke in, and you have to listen. I often say one of the great gifts of senior management, which is in short supply, but is probably highly prized, is the ability to aggressively listen, to speak less and hear and listen more. So that behaving with integrity is very important. It's about leading people as well, and leading by example to a large degree. It's very much about I suppose, nose in but fingers out at director level. You don't have to get into the weeds of everything, but you need to be aware of it. And people need to look at you as an exemplar in the space of what is expected. This is how we do things around here. So it's about that kind of being an ambassador for your company as well. And there is kind of a standard there which will come on, that that there is an expectation of probity there in terms of how you go about your business, because you are that flag waver for for Pinnacle in terms of how you go about your business. It's about exercising control, which we spoke about it earlier, and making sure that there is a clear line of command, and that you are challenging. And I think the term that is in common parlance would be constructive challenge. So when you're at the board and you're receiving reports from the executive, okay, your job is, you're not there to be friendly or anything like that, or unfriendly. You're there to be, receive the information and not get overly friendly. But there should always be a constructive tension at the board. It shouldn't be a happy nappy sort of operation. It should be kind of fairly workmanlike in terms of its aspect. And again, the term that is used is constructive challenge. So when policies are brought to you, when proposals are brought to you, it's about constructively challenging those in a positive way, where you add value and you tease them out and you question. Now, if you look at all the disasters that have occurred over the last 36 months, even in Ireland, the common trend through all of those was that people weren't asking questions where they should have been. They were just taking things as read. And there was issues arising as a consequence, some of them horrible, and are reverberating right through the system still. But it was where people weren't exercising control, which is a mandatory requirement as a director to be able to exercise that and to be seen to be doing that. More importantly, it's about working effectively. It's about teamwork. It's about kind of the spirit of the board. The board is a collective organism in of itself. It's not an individual entity. A lot of boards actually would operate on a confidentiality basis, that what goes on in the board is highly confidential, to the point where we see a lot of boards would issue confidentiality notes for when people come on board, just to sign that, particularly in kind of public facing entities where there'd be a lot more kind of potential damage, but it's not uncommon. And we'll touch on that a little bit later. And it's about being accountable and transparent. And I would say to you at the outset, in terms of these things, that for the avoidance of doubt in terms of the board, I operate on a transparent basis. One sees, they all see. So that's probably the lesson to take away. And if you look at all the disasters that have occurred over the years, 75% of them have occurred because people were ducking and diving and not sharing the full information. At a board kind of level, bad news is not like wine. It doesn't get better with age. You don't need surprises. You need to know about it as early as possible. So you need to have that transparency and kind of that understanding that you'll receive that information as quickly and in as timely a manner as possible. So those will be the principles which we will touch on over the course of the next hour or two. And again, they're not bad touchstones to actually think about. And that's why I put them there, to encapsulate what we're about. But it's really about advancing your purpose, your strategy, behaving with integrity at all times, and being respectful of those people around you, and again allowing people to ask their questions and hear what they're saying. It's about leading people and being seen as an ambassador. It's about exercising control and working effectively and efficiently. And again, it's all about time management. I think one of the big challenges with boards is time. That's one of the big things that people come back with regularly to us, is they didn't realize how much time this was going to take. So it's about that expectation of efficacy in terms of the papers you receive, that the chair gets through it in a workman-like or workwoman-like fashion and on a timely basis, and you get through the agendas. And it's about ultimately being accountable and transparent. Now, within that context, in the state space, you're looking at, I suppose, why is its corporate governance high profile? And you've got the Governor of Ireland piece, you've got the central bank is really pushing it at the moment, and you've got the charities regulator, which I just touched on. But perceptions that organizations are not being run effectively in the interest of shareholders has been a huge issue out there. And you've seen that, in the banking system, for example, and there's any number of areas that have arisen over the years there as case studies, where there might have been inadequate systems and controls in place, and you've seen consequences of that. Or there might have been, in the more broader space, poor standards of conduct or resource misuse is not uncommon out there. And one of the big issues clearly is insufficient risk management. And it's very important to have those risk frameworks in place and risk statements in place and risk appetite statements in place as well. The risk register is something that most boards would have in place, and particularly after COVID, where they might have had a business continuity plan. Most of them now have moved to a risk register basis, and that needs to be reviewed on a rolling basis at all board meetings. What we would suggest as a tip to you is that at each board meeting, if I'm assuming that you have a risk register of some structure, that you take one of the, say, just would say there's 10 items in the risk register, take one of them at each of the rolling board meetings over the course of your year and do a deeper dive for 15 or 20 minutes in that particular risk, so that over the course of a year, you'll get to actually know, and you guys will know this because you're in the business anyways, what your risks are. But for non-executives generally, it's not a bad thing to do to actually just pick out one risk and do a deeper dive in that. So over the course of a year, you get a really good granular feel for what the risks the organization are facing. And it's very helpful because while you might be very aware of a particular risk, it doesn't necessarily follow that your colleague would be as aware of that. So it's a collegiate kind of briefing on a rolling basis. But risk, keeps evolving, keeps changing. Brexit was a huge risk 48 months ago, 36 months ago on March 12th, March 17th. COVID arrived and no one saw that coming. And that's been a huge challenge. And all that flowed from that. We came out of COVID. You're looking at a logistics nightmare in terms of what happened with the Ukraine. And now you're looking at the Middle East and all those variables. So risk management and risk awareness is a huge time consumer in terms of boards. And it's one to be aware of and manage it within that space. So again, within the government space and the regulatory space, you have the Corporate Court Enforcement Authority has come into play. It got ramped up there in the last year. That's one to watch closely. Probably as a tip, again, I would put yourselves on their newsletter. It's free. Just type in your email address and they'll come out on a quarterly basis, just with updates and stuff like that to be aware of. Some of the codes that the majority of people will be aware of in the space would be the code of practice for the state bodies 2016, civil service have their own code, charities governance code, universities have all gone through the HEA Act 2022 in the last 24 months, and that's been hugely challenging for them as I heard as well. And they're having troubles there now in terms of compliance. You see that in UCC and TU, for example. Central bank codes, the individual accountancy framework regime got pushed back by about 9 months there due to recent kind of evolutions within that, and the FRC code. So there's any amount of codes out there. The one that you're operating to as I said, is the Companies Act 2014. And again, I would say to you seriously as a tip, go onto the Corporate Enforcement Authority website, register yourself for the newsletter there. And it's actually a good way of, without having too much kind of labor involved, they will ping you on a not a regular basis of what's coming down the tracks or what's interesting from their perspective. Equally, I would say to you as another tip, your auditor, for example, or your legal house, whoever that might be, normally do kind of updates and briefings on a quarterly basis. And what I would say to your accountants or your auditors, perhaps, or indeed your legal houses, ask them to give you a quarterly briefing of what's coming down the tracks from a legislative basis that they feel that's going to impact your business. And that can be very helpful as well, just as an early warning system. Now, a lot of them will be doing this as standard anyways, but it's no harm to actually ask them to do that as part of their offer to you. And again, it's that horizon scanning piece. I would say at boards, one of the things that boards can be weak at as a discipline is horizon scanning. It's very important to be looking out 24, 36 months out as to, what's going to hit you. So for example, there's a huge amount of boards out there at the moment looking at the CSRD regs that have sprung through Europe from the ESG. So the Social Responsibility Directive has vested this January, and there is a compliance issue for certain companies, which they're just getting to grips with in terms of non-financial reporting. So that again, you need to be picking that up at least a year in advance to actually put, I suppose, provisions in place to enable you to actually capture the data that's required. Now, again, that might necessarily hit you because it's, there's certain thresholds that you have to hit in terms of quantum of turnover, assets, amount of people working with you and so forth. And again, your auditors should generally be picking this up in advance and giving you some tips on that. So again, within the code of practice for the governance bodies, they're There, it's actually a good one to take a look at, because a lot of jurisprudence in terms of, when they look at it as exemplars of what we define as best practice is actually contained within this document. There are 10 sections in it. It's not exactly bedtime reading, but it's no harm to actually take a look at it. It will cover, for example, business and financial reporting requirements. It'll look at audit and risk committee guidance. And again, I would say to you as an entity, probably no harm to have one or two subcommittees of the board as well. And probably the main one there would be your audit and risk subcommittee. So most boards now, without exception, would have an audit and risk subcommittee that would be expressly looking at that whole area of financial risk and audit and stuff like that. So again, maybe you do, maybe you don't. Food for thought. But this particular code would give some guidance in that, give some terms of reference, for example, in terms of how that might look from your perspective. There's generally a remuneration and superannuation piece in terms of guidelines, in terms of dealing with that, because it's good for the avoidance of doubt to have some templates built up that people can look at. And again, there's a whole area of board self-assessment and evaluation. And I would say to you, it's probably not a bad thing. We see a lot of boards would do a health check, as I would call it, once every 3 years, to do a board evaluation that allows an independent to come in, have a look at how they're getting on, generate a report, and it allows people to have a chat independently and surface any issues that mightn't be comfortable with directly at a board or something like that. So it's another avenue of being able to do that. And where we find that finding expression would generally be in advance of sales. So if a company's getting ready for a sale or something like that, they often do that health check just to see if there's any kind of thing that they're missing as a collective entity that can be surfaced. And what we're seeing more recently as well, just another tip for you, is we're seeing boards doing competency and skill set audits. So competency and skill set audit is something you do midterm. So you're appointed to the board. You generally get appointed for a term. Okay, so whatever that term is, 3, 5, but it's generally there's a specific term, and you will get a letter at the beginning just outlining what the details of and the expectations of in terms of your directorship. But what a lot of boards would do, and maybe not so much in your space, but if you had a few external non-executive directors sitting or whatever on the board, you do a snapshot to make sure that you have sufficient skills around the table. And where that finds its expression would be, so as an example, you'd be an IT company. So I'm going to guess that you would have significant um, uh, deep domain knowledge in the particular area of endeavor that you're in. But you mightn't necessarily have, for example, deep domain knowledge. You mightn't have someone who's a solicitor or a legal expert on the board. And sometimes that can be helpful at a board for obvious reasons. Or, an accountant or someone with a heavy accounting background or something like that can be very helpful. Or, how long is a piece of string? A cyber risk, clearly you would know, is a huge advantageous thing to have someone with those skill sets on the board at the moment. So again, that competency and skill set audit is a snapshot that's done once every couple of years to make sure that the right people for the right fit are on the board and that there are no gaps in terms of that. And sometimes it leads to people thinking about appointing an external or something like that to backfill an area that you may or may not have a weakness. Okay. So that all comes together in terms of, I suppose, why are you doing this? It's all about organizational success. And again, we encompass those in those kind of four sweet spots of the people, that you have the right people on the board in terms of your competencies and the skill sets that they bring. But that also, and that's all vested in transparency, that you have processes in place that underpin all that. And you should be looking at, for instance, policies coming to the board and policies, where I would say, for example, from a CEO perspective, you would have derogations and delegations to the CEO, but you'd have matters reserved specifically to the board, whatever they may be, and they should be looked at annually. So those processes and policies need to be reviewed on an annual basis, and have that stitched into your governance kind of calendar. And I would also suggest to you that it's no harm to actually have a governance calendar for the year, that the dates of the meetings, for example. And sometimes where we're seeing people now is actually thematic stuff, that they pick a particular theme at each meeting that they'll touch on. But to have those processes in place, whoever your company secretary is, some outsource it, someone appoints someone in the house or whatever it is, but just have that kind of, I suppose, tapestry throughout the year in terms of the cadence of the board and have those sweet spots hit. And, being responsible and kind of having that judgment in place. And it's about performance at board level equally. You're there to deliver the pup, you're there for a purpose, and you're there to, I suppose, enhance the performance of the organization. And you have a duty of care first and foremost to the organization, to the company above all others. And we'll touch on that. It's about being fair and equitable in your dealings as well. And that goes back to that transparency piece. And it's about purpose. What is the strategy? What's the, what are the kind of the KPIs, if you want, that kind of, what does a good finish look like for you on a particular given year or in a 3-year period? And some of the key issues we see, I suppose, really coming up, recurring on a regular basis, is that whole piece about board composition. And you will have heard of diversity. That's clearly a big one at the moment on boards. And it's more, it's not just about, I suppose, gender diversity. It's also the experiential diversity as well. That's very important. But be mindful of tenures. People can serve too long on a board, they can get tired. So you need to have a rotation policy in place as well. And the chair needs to be talking to people on a one-on-one on an annual basis, just to make sure they're still comfortable, that they're clear about where they're at, and that they feel that they're adding value. It's about having that kind of whole stewardship of the chair as well, and having that relationship. No harm to have an independent on the board, I would say, regardless, as good practice as well, just to keep the whole thing kind of on the straight and narrow. Because boards, if they don't have an independent on the board, sometimes can get very parochial naturally to the endeavour that they're at. So sometimes boards, as they grow, would appoint an external just to actually, I suppose, add some value and keep some clarity between the two. And it is that kind of relationship between the board and the executive. Now, again, it's about information flows, and I would often say that it's about a no surprises basis. The most valuable asset of comfort that a board can have is that they have an assurance that they're not going to be surprised, that they're going to get bad news early rather than late. So it's again that assurances piece, that you trust the information flow you're getting. And that, again, that the board is focused on its performance at all times, because ultimately that's what you're there to do. It's about performance and conformance and assurance. And that's all encompassed, I suppose, in organizational culture. And culture has become a huge issue in recent years. And that's vested and grounded in behaviors, tone, ethics, EDI, equality, diversity, and inclusion, and so on. So that's become almost a field in itself in terms of corporate governance. And rightly so. But I would say most boards now, from a diversity point of view, are well ahead of the curve there. It would be the exception to the rule almost at this stage if you saw a particular kind of huge kind of balance in one way or the other. And then the other kind of major issue that's coming up is that whole sustainability piece in ESG. ESG has become a mega trend, and again, within the context of tendering moving forward. For example, in the state space, there's been some new kind of evolutions there, that there's a requirement to be able to kind of explain how you're, reducing your carbon footprint, as a case in point. So those rules and regs are coming in from the Office of Government Procurement, if you're in that space. But more generally as well, you're going to find it through the CSRD regs, because as a supplier into someone that's in that space, particularly banks, for example, they're now going to be pushing it down on yourselves if you're dealing with them, to actually be able to give them data and as a supplier. So it's a third party kind of issue that's going to come down, if it's not already coming down, in terms of your own sustainable footprint. So it's capturing those pieces and starting to, I suppose, collate that data and have it in a fashion that's correct and proper for the entity that you're supplying into, and to get ahead of that. I think, a lot of people have had these conversations already. If they haven't, I suspect they're coming, and it's going to hit all entities in due course. It's kind of a phase basis from now up until 2028, at which point, SMEs are certainly going to come into the fold, and there'll be a huge sea change in terms of reporting and compliance in that space. And it is an Uber trend, a super trend. It's not going to go away. I think that ESG space is going to be dominant, throughout the next 20, 50 years. And rightly so. I mean, the planet is certainly kind of struggling at the moment. Now, having said all that, when you look at that and step back for a moment, organizations need to have matrices. And if you look at kind of, for example, let me just pick one up here. So that's a case in point. That looks like, sorry, Paul, forgive me. I didn't see your hand there.
Yeah, no worries, Pat. I was just I didn't want to stop you in the middle since
No
put the hand
problem.
up. It was just more of maybe just a point just to for clarity, perhaps that maybe just for contextualizing, I suppose. I think from our perspective, I know we would deal with, say, and Emer and Marita obviously in PTSB, and John and I in Bank of Ireland would deal with the exco of the companies and the board as well. I've spent the last week writing and rewriting board papers, but I think from a point of view of ourselves, we're and just for context, that we are probably the exco and the board in terms of the work we do. We don't, there's nobody in the company outside of the four of us at the moment in terms of who manage the decisions on a day-to-day basis about where we are and manage the direction of the company as well. So I wasn't sure if you're aware of that, but I suppose
Yes.
just for context, that's kind of how we're structured.
Yeah, no, I got that. And that's why I suppose it is it's that door. So Paul, when you go through the door and you're having a formal board meeting, which is minuted, okay, it's slightly different from your management meeting. So you're required under law to have a number of board meetings a year, and they have to be minuted in a book. And I'll go through those details with you.
Yeah.
So that they are considered under Irish law legal documents. So when you're in play, they are the it's a slightly different nuance, for want of a better word, than that. But it is tricky, I suppose, and that's why I mentioned earlier that differentiation in your own mind between a management meeting and a board meeting. That is a tricky one. But I suppose it's just having that kind of mindset when you are formally having a board meeting or your AGM or whatever it is. It's just a different nuance in terms of that and the logistics around it, if that explains it.
Yeah, no, that's fine. Thanks, John. Or Pat, sorry.
Okay.
John's
Emer,
name.
hi, good to see you. So, okay, within that context, and that's a good segue to show you kind of what a beast looks like from a corporate governance perspective. So that's an example of one of the health, the whole Minister for Children, the HSE board. It's a big beast. Okay, almost impossible to kind of get your head around in terms of managing that sort of scale and size, particularly when there's so many different constituencies and jurisdictions within it. There is a rule of thumb within executive management, which I'm sure you're familiar with, to the rule of eight, so that no one should have more than eight people reporting to them. Now that isn't a bad kind of direction as a general kind of rule of corporate governance as well. So we would often say the rule of eight. When you're looking at things, you shouldn't have more than eight people reporting directly to you just from a management time point of view. We would say kind of a more reasonable kind of way of looking at a board, and I just picked out an example of what that might look like, is if we just pick a smaller statutory board. You got your CEO, and then you got your various directorates underneath that, and they'd be the standard ones of maybe HR, information, IT, corporate services, and so on. And then the flow down from that. So that's a more standardized board, for example. And then, if I was looking at a standardized IT company as a case in point, so if, that wouldn't be an uncommon one where you've got a, president, you got a vice president using the American technology, and then you got the various different kind of IT technologies, proactive project management, client CIO, and, whatever they will be. So generally not a bad thing to have an org chart, and I'm sure you have one anyways. But someone has to kind of be the skipper, and someone has to actually do I suppose, the governance piece of it as well, and the admin side. And can I ask you, who's your company secretary as a case in point? Do you outsource it, or is it your accountants, or do you have someone nominated among yourselves?
I think it's fair to say, Pat, that we're forming the board at the moment. We're not really up and running formally, so that's why this is brilliant
Okay.
to kind of point at what do we need. And I think, yeah, the whole, putting ourselves in a different mindset at a board meeting and having the right processes and procedures, we need to be doing this now.
Okay. So that's fine. And what I would say to you as a tip at that case, and for yourselves, you have the luxury of not being kind of preordained. So I would say for an organization such as yourselves, you're very busy directors and your normal day-to-day operational tempo. Okay, I would probably consider for yourselves, but don't hang me on it. You'd probably outsource that company director piece to your accountants or something like that, which is perfectly acceptable under the law. At the first remove, and get that discipline in place. You must have someone doing it as it stands, who's doing your company secretarial stuff, because you're up and running. So I'm guessing it probably is your accountants and maybe your solicitors. I don't know. But it's that probably piece is just one to be mindful of. I'll come on to it in a little piece in terms of, and we're just going to touch on it now. So I mean, defining what, a company director is, and maybe having a look at that from that perspective in terms of what a company director is, and maybe I'll just go through the roles and responsibilities. So directors are responsible for, I guess, ensuring that these particular 6 areas, that there's the whole kind of piece is in place. So you need to have, a register of members as a case in point, or the company secretary needs to have a register of members. You need to have a register that could be shareholders, for example, but separately you need to have a register of directors and secretaries, which is why I asked the question. And again, you also have to have a register of directors and secretaries' interests. Okay. You need to have a register of debentures holders, for example. You also have to have minute books in play. If there are director service contracts in place, you need to have those, or the company secretary needs to have those. You need to have contracts or copies of contracts to purchase your own shares, and indeed any individual and group acquisitions on the share register. So that piece of paperwork is not insignificant, and someone needs to be accountable for that, and that's why we kind of spend a little bit of time on that, to be aware of the register of interests and so on. And what I would say is good practice is to build up a little book. We do a lot of this for companies, a corporate governance handbook. Okay, and that's a living document, and you can have it on your server or whatever it is, and you update it with the various bits and bobs. But when a new director is coming in, it's very handy for an induction perspective, and within that as well, you'll have some templates. So, for example, that letter of appointment is important as well, because that lays down the framework of your company, what your expectations are, and all the various terms that will apply to someone as they become a director. But again, within that context, all of you, regardless under the law, you have to comply with your governing documents. So your constitutional documents, always a good thing to take a look at them. And they may be generic, that were kind of, which was not uncommon when companies were set up, or they may have specific provisions. If there are specific provisions to Pinnacle within the company docs, you need to be aware of them and call them out for people when they come in so that they're aware of it. I'm not suggesting you should have them under your pillow, but at the same token, people should be aware of what they are, or at least have access to them. The one problem with corporate governance under the law is ignorance is not a defense. So you need to have that kind of, I suppose, suite of documents from a governance point of view, somewhere kind of central, a central repository. And as I say, we do a lot of that for companies, because it kind of collates the whole thing in a readily accessible area. And again, it goes without saying that you need to ensure proper books of accounts are kept and in place, that you're managing the assets appropriately. Act with reasonable care. Now, that under the law is an interesting one. What is reasonable care? And again, it depends on what's taken into account by the judges and stuff like that. Is your skill set, your knowledge sufficient onto your needs, what your background is in terms of a particular area, and there would be a higher burden on people that have specific skill sets. Say, for example, if there were accountants or stuff like that, and there was a fiduciary issue, there would be a higher or a lower bar there from themselves, for example. So the reasonable care piece is within your knowledge base. But again, ignorance is not a defense under the law once you sign in the dotted line to become a non-executive director or a director. And I'll come on to the differentiations, because the law doesn't differentiate between executive, non-executive, shadow, and so on. You need to ensure you focus on your agreed strategy. And it is important, guys, once a year to go away for a day or a night, break bread outside of the hurly-burly of everyday interaction and stuff like that. Step back and take a look at where you're going. And most boards would take an opportunity there to do kind of a morning on strategy, just to review the strategy that you have in place, take a look at how it's doing against your expectations, and revisit and recalibrate it if necessary. That would be very standard. People go off down to Connemara, go to Portugal, whatever it is, doesn't really matter. But that you take the time to step outside the day-to-day work and look at the strategy. It is important, because it can be very busy. You just mightn't have that opportunity and that discipline to do it if you don't set the time aside. And ultimately to ensure you remain as an ongoing concern. And within that piece, you have to kind of, I suppose, enable the company to have the resources to provide the leadership to put them into effect, which by definition you are, because you've populated the board and people are aware of their obligations, or getting aware. And you're there to supervise the management of the business, and I suppose report back to yourselves as the shareholder. Or you may equally have, for example, stakeholders that are external to you that have an interest in the organization that you have to report to. And that's where AGMs find their expression as well. If you do, so be it. If you don't, that's not really an issue. But just to be aware that you're there to kind of actually manage the managers in that case when you have your board hat on. And again, as I say, all these are subject to the laws and regulations of the Irish state and also the EU as well, just to be mindful that there are some overarching obligations. And within that context, just from a law point of view, health and safety, we get asked this question a little bit. You have specific obligations under health and safety to your employees, and they trump all others. So, and you know, that would really be kind of making sure that they are operating in a safe environment and that you're providing them with the, you know, the appropriate kit to get their job done and so forth. And that, you know, coming out of COVID, you would have seen a lot of things about wellness and so forth, right and proper and so on. But health and safety does have a higher threshold of expectation out there, and it's an unforgiving environment. So when you see actually people getting you know, in the law, actually it's health and safety where a lot of the penalties have been imposed. So just to be aware of that as well. So you need to, I suppose, define what your values are as an entity. Okay, that's important within that, whatever they are, how you know how we do business around here, and you need to embody those values, I suppose, and be impartial and fair to all when you're out and about and doing your duties as both an executive but also as a director, so that people can see you as an impartial figurehead of the organization. And you need to work together as a team. You need to have a collated purpose. You need to be kind of focused on the end game, whatever that end game is, as defined within your strategy. And as I say, strategy have moved from 5 year. When we look back, you know, it was standard to have a 5 year strategic plan. That doesn't really exist anymore. The max strategy you're looking at now is 3 years, and I think COVID has taught a lot of people that it's a bit like the old rule of engagement that the best strategies don't survive first contact with the market. So there is that strategic day that we talked about earlier. Is becoming important for people to actually touch base, recalibrate, reboot, retack, whatever you want to call it, and you know, be agile. That word which came into expression over the COVID period, but to be agile in terms of how you go out to the market and be able to react as quickly as possible, and that goes to that whole no surprises pieces, and that you're in regular communication as a board of your nature would be, because you're small and you're communicating across the piece on a regular basis. And again, it's about managing and identifying conflicts of interest such as they arise. We get a huge amount of questions about conflicts of interest, and I'll just touch on that a little bit later, just for the avoidance of doubt. And I suppose within that, you know, that acting with reasonable skill and care. So when the judges look at it, you know, they're going to ask, were you aware and were you complying with your duties, which were outlined to you as a director, is one of the questions you get asked, and you can say yes or no, or they will ask you, you know, for example, did you read your constitution? Were you briefed in it? You know, they look, for example, you know, can I have a look at the induction that you received in terms of what was the induction? What did that look like? So just to be aware of that. So that's why I would say the induction is very important, that you actually know whatever your articles are and your paper, whatever that is, to be across it and get a good briefing on it. And what sometimes we find with that is that some of the organizations we deal with, like yourselves, will bring their solicitors in maybe to go through the Constitution just to call out any particular specific areas, or we do it ourselves, but generally people take comfort if a solicitor is doing it. So that's just an interesting aside, if it is a specific Constitution created for yourselves. And again, what I would say, if you're recalibrating your Constitution, you know, there's a couple of sweet spots just to be aware of. And the one that regularly people come across on is quorum. Okay, so I don't know what your quorum is, for example, for a board meeting. So, but you need to actually in your minutes say that you will quorate. So whatever that is, I would imagine you're a small board, so you might need kind of 2 people at a minimum, I'm guessing. I don't know. But if, for example, you have 5 directors and the quorum is 4, that's the high bar if someone's off on a holiday and someone has COVID or whatever it is. So just to kind of stitch those things in, it's that pre-planning piece. And if it is a challenge, you know, because it cannot be a board meeting if you're not quorate, just for the avoidance of doubt. It doesn't legally exist. So you know, you can address that by actually an EGM or at your next AGM, just reducing the quorate, whatever that is, but that will be covered in your Constitution. Your board papers, such as you're getting them in advance, general best practice would indicate that you get that your expectation should be, if you are getting board papers as a case in point, you get the agenda out, for example. If there's board papers, best practice would be that you get them a minimum of 5 working days in advance. The reason you would get them 5 working days in advance is you have time to percolate and read them. People are very busy, so that's the standard practice. It would be an exception to the rule that you're getting board papers out within 48 hours. And if they are, they're generally for noting, not for action. Now, again, that's all fine and dandy, and there are exceptions to the rule, but they're the general standards. So it's 5 days minimum, by exception, 48 hours, and it's for noting. And again, one of the big issues that we see coming down for all boards is that the packs are getting bigger. So that discipline of actually managing to get through the agenda in a timely fashion is in of itself quite an art. And people ask us regularly, what's the ideal time for a board meeting? Well, there is no ideal time, but 2.5 to 3 hours is about right. But they can go on all day and all night, go into the next day. But generally 2.5, 3 hours should be about right for an active humming board to get through it. But it is a discipline, and it is down to the chair to actually crack the whip and get people to make their contribution and keep their agenda rolling. And you're there to make balanced decisions. Now, the decisions might necessarily personally be attractive to you as a personal kind of issue. You might necessarily kind of like the decisions that you're making, but you have to collectively look at it in terms of the best interests of the company, the organization, as opposed to yourself. And that's one of the real, I suppose, issues that people struggle with sometimes. Sometimes they cannot leave behind their parochial kind of interests at a board, but once you go through the door, spiritually speaking, at a board, you have to leave all those kind of individual traits that you have and look at things in the round, because you're there looking at it as a collective entity and what's the best for the board, what's the best kind of advice that you can offer, what's the best kind of outcome that you could look at. And as I say, it mightn't necessarily be personally attractive, but when you have to step back and look at it, that's why hard decisions sometimes have to be made, and you have to, go along with that for the greater good. So again, it's about reviewing the performance of the board regularly and making sure that it's fit for purpose and that you're hitting those sweet spots. As I say, a humming board is a lovely thing to see. It's very efficient, it's effective, and you get to know the people around the table. It's kind of like a high performing team, for want of a better word. And it is important, I suppose, again, we had a huge move towards hybrid and virtual board meetings, and this is obviously virtual today, but my own preference is for in-person board meetings as regularly as possible, because it is that kind of magical sauce that people have. It's the kind of the unwritten kind of communications that go on around the board. People get to know the sense of each other, and they get the body language around the table, and they know. So that's really important as well. And the only way you can do that is by spending physical time with people around boards, or breaking bread on an occasional basis. So again, to have that kind of discipline of having, if you are virtual, fine, or hybrid, fine, but at least have stitched in recurringly, maybe every second or every third, a physical board meeting, because it's important that people come together. So, I would say to you, the takeaways there is to pre-read your papers. Don't come in blank, because catching up on the day is just wasting other people's time while you're kind of trying to read into the papers on the hoof. Never a good idea. It's not a good look. Again, have a look at the agenda and see what the outcomes are that are important for you. And again, from a chair's perspective, have that agenda, make sure that it's fit for purpose, review it regularly, touch base with the other directors, and make sure that the time is being used to their satisfaction as well. Deal with conflicts of interest. Conflicts of interest is a huge issue in the Irish context, and we'll touch on it. Keep on tracking on time. Don't get sidelined by AOB. What we see in more general boards, not so much for yourselves, because you're going to be, I'm guessing, quite disciplined on the mission at hand, but you're going to have people with parochial interests who just go down rabbit holes and soak up all the oxygen in the room because of this pet hobby that they have. That's not acceptable anymore. So what we've actually seen now sometimes is some boards take AOB at the beginning. Okay, at the very beginning, which is an interesting kind of observation that's occurring more recently. But AOB is not designed for hand grenades or landmines. It really is any other business, which is by exception. There shouldn't be a huge amount of AOB. It should be just for noting generally. So, it's been in the past, particularly in AGMs, AOB has been an area for nightmares. So I would manage the AOB very clearly and very carefully in that regard. As a general rule of thumb, it's no harm to summarize the key decisions at the end of the meeting in terms of what decisions have been taken and agree. And very important that everyone is aware of their meeting date for the next meeting, the time, the location. I would say to you again, best practices, you should have a governance calendar. At this point, you should know your governance dates for the remainder of the year, if at all possible, from a board meeting perspective, because people's diaries are very busy. You're into different jurisdictions and so forth. So it really is helpful that people in December are getting the full 12-month kind of cadence of the board meetings and times for the year ahead, so that they can make sure that their diary is there and they've set the time aside. So again, I suppose the whole area in terms of efficacy on the board and what that might look like for yourselves, what is the number one thing that you are asked to do as a board director, regardless of be it Pinnacle or be it New Era or be it Microsoft? Well, the number one thing you're asked to bring is your independent judgment and scrutiny, that you are expected to bring your independence of thought and ask those questions. That's the number one thing. That's what they talk about, independence. So that kind of addresses that piece about conflicts of interest, which I'll come on to on the next slide. But again, it's to be in a position that you are constructively challenging the hypotheses that have been brought to you, or the proposals that have been brought to you, or the policies in a supportive fashion. And again, it's to add value. You're not there to be overtly critical. You're not there to be nasty or taking pot shots. You're there to add value. But the term we use is to constructively challenge. And again, to read yourself into the brief and kind of, I suppose, be measured in terms of the area. And you know what I would often say to people, it's okay not to have an opinion on everything. And nor should you. It's okay to actually step back and kind of say, well, you know what? I don't really have an opinion on that. I think you can share your thoughts, initial thoughts and stuff like that, but it's okay not to have an opinion on everything. And the other thing, even though you are operating on I suppose, a commercial basis, insofar as you're both employees and directors of the entity, you have to put the time aside for the governance aspect of it as well, in terms of setting aside a time within your normal kind of work routine for the governance commitments and so forth, and think of it as a governance commitment as opposed to part of your normal working process. Now, again, for the avoidance of doubt, there are penalties out there. There's some nasty stuff out there in terms of non-compliance with the acts and stuff like that. And if you fall foul of the company's company's law, or the fall into the compliance space, you could get in a doomsday scenario from a non-compliance piece, you could get struck off as a director, or you could get unlisted. And it's not so much, they're generally time limited, or there could be fines, for example. And it's not so much the time or the fine, it's more the reputational damage that can occur as a consequence of that. And those are published, for example, and you're seeing more of that happening. Traditionally, white collar issues weren't kind of something that were taken as seriously as they are now. But make no mistake, they're certainly moved into a completely different kind of area now, and people are very aware of it. So again, I suppose, this from fines to, God forbid, imprisonment, and the various conditions which they may be applied. And you would have seen kind of one or two people going to prison over the last couple of years. There was an awful case there. I think I remember some poor guy came a cropper in terms of the whole area. I think it was to do with fruit, for example. I'm just trying to think of the actual working example of it. Where he spent some time in prison as a consequence of accounting issues that were egregious in the views of the court. But they are being enforced now. They are certainly a serious matter. There is no defense under the law for ignorance. So you need to keep yourself up to speed in terms of the rules of engagement, as you are. But I would take it seriously. I wouldn't for any second, let your guards down in this area. I would say once you're on as a company director, you're a company director 24/7 for the period that you're on. So always be aware, always be kind of doing a bit of a horizon scanning, seeing what's going on out there, and keeping a weather eye on what's in the zone in terms of what the touch points are, what the hotspots are, in terms of corporate governance. And I would say you should have strategies for compliance in terms of that space. And to that point about maybe getting your accountants or your solicitors to come in and offer some practical advice on ensuring compliance with stuff that's coming down the tracks from, I suppose, both a fiduciary and a statutory duty point of view. And again, I would strongly urge you to stitch in a regular review of your company policies as part of your compliance strategy as well, because they needed to be updated. I think the first time a lot of entities probably looked at that in a meaningful fashion was the GDPR regs, if you recall them, not that long ago, but long enough ago. But I mean, just to be aware of that, there's lots of different kind of things that can impact you. So, for example, where we see companies in the commercial space come a cropper that are dealing with entities that may have exposure to the state, or maybe the state has a shareholding, for example, in an entity that they're dealing with. You need to be aware of FOI implications, that, it could conceivably occur that documentation that your emails or whatever could fall within the provisions of FOI. So it's probably no harm every now and then to touch base with the entity you're dealing with and just ask, for the avoidance of doubt, is any of this stuff FOIable? If, for example, a bank, as a case in point, who might have, as a shareholder, a significant shareholder as the state, are there any implications from an FOI perspective? Good question to ask. And I would say from an FOI point of view, I would use the analogy of, dance like no one is watching, write an email as if you're explaining it in the High Court. So just one to be wary of. More people have come a cropper on FOIs than any other single entity in my experience, where they just weren't aware of the rules of engagement there. But I'm not telling you anything you don't know, but be hypersensitive around emails in that space or traffic in that area. I'm just going to touch on conflicts of interest because it's the number one question we get asked the whole time. And, whatever the board is, everyone knows everyone in Ireland. And I suppose just to touch on it, maybe, you have a duty of disclosure as a director, and you're required under Irish law to disclose, certain kind of issues. So, for example, you're required to disclose information on the register of directors and secretaries. So that'll be, for example, your name, date of birth, address, nationality, occupation, details of any other directorships. Those would be those B10s that you'd be familiar with that you sign every now and then. You also are required to register any interest in shares of the company or indeed related companies. So, for example, we discussed earlier perhaps that you might set up one in the UK. So they all need to be copied and put into the register of directors' interests, which are available out there. You have a duty of director to disclose payments in connection with any share transfers, or indeed those service contracts which we mentioned earlier. So again, I suppose that whole area kind of, you need to be on top of that as well and make sure that it's fit for purpose and that paperwork is in order. Generally, your accounting practice often fulfills that role for you. So if, I'm guessing 9 times out of 10, they're fairly probate and they're on top of it, but no harm just to ask every now and then are we up to date? Is there anything else we need to be doing? From a conflict of interest point of view, so I suppose really, it's the whole area of conflicts of interest. There isn't a board meeting now in general kind of operational tempo that doesn't have after the minutes, after the apologies, conflicts of interest as a line item, as a standard line item. So I suppose when making those decisions, I suppose following that ipso facto, I suppose the following factors you need to really be thinking about it. Is there a conflict between your private interests and your duty as a director? Okay, so for example, you may have a particular interest in something going down a particular way, or buying whatever it is, software from an organization that your wife is a director in. So it's that kind of issue. Okay, what I would say about conflicts of interest is it's about transparency. If you have in your mind a doubt that you have a conflict of interest, okay, you probably have. And the simplest way to deal with it is be transparent. If you think you have, just say to the chair and just say, look, I think I might have, just want to flag it there that my sister or my brother or my whatever it is, my husband, my wife, my partner, is a director or whatever it is of that organization. I just want to flag that, she's there. I have no hand or back to partner that we're not looking for, there's no kickbacks coming or whatever, and let them make that decision. And that applies to your own board as well. So, so that decisions that are taken by the board should be solely on their merit. And that's why that three line kind of quote rule came in. So that 3 quotes came in. That people could actually look at it on their merit and have a stack up in terms of a percentile, in terms of, what area did we go down on, what area did we win the quote on, and stuff like that. So it's that whole area. And again, it's, when people talk about it, in terms of the Irish context, it's a big kind of area. You got the decisions are made by the individual, or their spouse's child or next of kin, just, that specific area, or relative. Is it a relative? Now, that business associate is a broader church. And again, I haven't seen any particular kind of issues arise because that's a very broad church. But a relative, certainly out to first cousin, would kind of fall into that. I think, logically speaking, in the Irish context, beyond first cousin, the whole Pandora's box opens up. I think second and third cousins are nonsense. But again, just to be aware. So my rule of thumb here from that is really just be transparent. And again, it's that two-hat dilemma, conflict of loyalty. Is your loyalty to Pinnacle, or is it to, another entity? So again, it's just for clarity, and have a clear understanding. It's no harm to have an operational kind of set piece in terms of a policy for the board there, that if you feel you have a conflict of interest, you put your hand up. You certainly remove yourself from the discussion, and you do not partake in any decision that's been minuted or taken in regard to the outcome of it. But again, I find the best thing to do is have a chat with the chair in advance, and that's why you read your papers in advance to say, look, we're being asked to make a decision that's coming up. I just want to flag that I have a material interest in this, or it could be perceived that, my particular kind of element of the equation could tip it one way or the other, and one of my relatives is working there, and I just want to be upfront and open about it. So transparency is the order of the day there. That's your get out of jail free. And again, there's a couple of questions I often say is, to ponder and ask yourselves. So who represents the board, for example, in terms of, are you representing the board, or are you representing someone else kind of informally on this? Are you being clear that in your own mind that it's the greater good of the board that you're making the decision on? And again, just to kind of revisit what your responsibilities are, your duty of care in the first instance is to the board, rather to the company. It's not to any individuals, it's not to anyone else. So that's your responsibility is to the company in the first instance. And again, to just be mindful of what is classified and what is confidential. As a general rule of thumb, okay, all matters at boards are considered confidential, but mightn't necessarily be classified. What brings it, that's a matter for yourselves if you are dealing with information that's classified or sensitive or hypersensitive. So those are matters that you need to be aware of. And again, having those kind of things that just, I would say to you as a tip, if you are taking minutes, okay, it's no harm every now and then. And I saw this recently where a company was being sold, where someone made the observation who was buying it that actually the sign they thought that it was a healthy entity in terms of their board governance was that in the minutes they'd actually someone had put their hand up, and it had been recorded that they had a conflict of interest. And it was said, we were talking to the entity that were buying it because we'd been asked to throw our eye over the thing from a corporate governance point of view. One of the guys said to me that actually what the takeaway from all the paperwork that they got in the minutes and stuff like that was that they had actually noted that someone had put up a conflict of interest had been noted and dealt with. And they said that particular totem pole of trust was actually what tipped it for them, that they felt that they were really dealing with a probate organization that was adult, mature, and healthy, that they could actually have that there dealt with in a professional manner, and it would recognize that it had occurred. So again, as I say, maybe the tip there then is, if one arises, flag it. And it's almost inevitable in the Irish context, given the size of our population, that someone's going to know someone. So it's no harm to actually minute it and say, look, perceived or potential conflict of interest, had a structure in place, dealt with it, nothing to see here, and move on. It all comes back to, and I suppose back to your director's duties in terms of ethics and dealing with it. And it comes back to how you're leading your organization. It's about exercising that control over the organization. It's about being transparent and accountable. And really, kind of transparency is the one word, when you leave here today, just think of that byword of transparency as the key metric there in that space. And efficacy, using your time and behaving with integrity at all points. Now, what I'm going to do now is maybe touch on the actual, under Irish law, what the types of company director are, okay, for the avoidance of doubt. And again, before a person can be appointed as a director of a company in Ireland, the company has to ensure that, you're eligible to hold the position of director. So, for example, certain people can't, or entities can't, or are ineligible to hold office as a company director. So I would say a body corporate or a non-incorporated body of persons can't be. A person who's under 18 can't be. An undischarged bankrupt cannot be company director. Obviously the statutory auditor of the company can't be. And again, if you're disqualified from acting as a director by the courts, you cannot be. And that's really interesting because the enforcement authority now is publishing for the first time people that have been struck off or that are suspended or whatever. And that's become, you know, that they're getting a significant amount of hits in that. I was talking with one of them recently. It's one of the more interesting areas. They've seen a lot of hits in terms of their own website where people are looked, because historically it was quite hard to find out unless you went to the court service who was struck off and who wasn't. But now it's open and it's transparent, and it's actually having a reverberation down through people who are doing due diligence to make sure that people aren't struck off. And again, I suppose, you know, all the individuals, be they shadow directors, de facto directors, and so forth and so on, under the law are all considered as directors. Okay, so be you an executive director or a non-executive director, you are a director. You know, just you know, regardless of whether an individual is one or the other, you have exactly the same legal responsibilities under the law. So a shadow director, to break it down, is someone who kind of sits outside the organization and is controlling it. Where you would have seen that in the media, and I'm not speaking of any, you know, anyone that's not in the public domain as an example, but Sean Quinn and the Quinn Group, he was, you know, regularly being accused of being a shadow director, that he was sitting outside and controlling the from an external point of view. So, you know, he was used as an example of a shadow director. Now he disputed that fact and so on, but might be the best example in the world to use, given what occurred. But that was an example there in terms of that. De facto directors are not unsimilar, but they would be people that are operating within the company and for all intents and purposes hold sway. They mightn't hold the legal title of director, but they are informally directing the company in terms of all the decisions that are being made. And not something that we would see that often in the Irish context. Shadow directors would be more common. Alternate directors are again, and we've seen a lot of alternate directors come in since COVID, where if someone goes down in flames, they're sick, they're out, whatever, you know, and it comes down to issues of quorum, so that an alternate director can be appointed if someone is out, for example, on maternity leave, or they're out on sick leave for 6 months, 8 months, a year, whatever. An alternate director can be appointed to make sure the quorum is in place, and that provision is often encapsulated in constitutions now as common practice, and it's probably a good risk mitigation thing to have in play if there's a fear of quorum. Managing directors are self-explanatory, and they're appointed by the directors of the organization. Executive directors are yourselves, for example, in this instance, and non-executive directors are those individuals that are appointed to the board but are not involved in the day-to-day operation and would come in for board meetings. And again, the big challenge between you know, non-executive directors and executive directors is just having that difference in their mind of church and state. We often get the case with non-executive directors in charities as a case in point, where they just get too involved in the day-to-day stuff and cause huge ructions with the executive management. So again, just to be aware that under the law, everyone is treated the same. You know, 1 to 6, you're all directors. But there are, you know, nuances within that as well. So you clearly fall under category 5. But I suppose just to be aware of that one, I would say as a tip for the alternate directors, depending on what your quorum is. So as statutory duties there, so as a company officer, chairpersons generally kind of, in our experience, the I suppose the nomination process is generally for about 4 years, and they get reviewed. You know, the rule of thumb is 9 years is about right for a company director. That doesn't apply to yourselves, for example, but if you look at the charity space or the state space, the rule of thumb, actually the best practice kind of recommendation is 9 years is your maximum term as a director. Another question we get is how many boards can you serve on? So again, how long is a piece of string? In the financial services sector, obviously there's a higher threshold because of the nature of some of the boards that are in play there. I think it's up to 20 for professional directors in that space, but it's a different kind of issue. In terms of general boards, such as yourselves, or kind of, you know, the broader entities, PLCs, and so on, it's 5. So they would say that, you know, 5 is about as many as you can possibly juggle at the same time. And I suppose the reason for that is, if you think about it, a lot of boards generally have their meetings on the last Thursday of the month. By definition, you can really only go and attend one board meeting at the same time. So you know, once you get into the numbers there, you're going to be juggling diaries, and it's almost impossible. And you don't want to be in a situation, particularly with the optics and transparency as it's going, where a lot of boards now are publishing attendance at board meetings, particularly in PLCs, for example. that you are showing that you're not attending, that you're an absentee landlord. So the rule of thumb there is about 5. But again, that's down to yourselves in terms of what you put down as or if indeed you do specify within your constitution what the term of reference is. And that would, I suppose, also play into the letter of engagement in terms of how long people are appointed for. It can be equally, there's nothing wrong with being open-ended, but it's probably no harm as a mitigation thing, just to have a situation where the post can be reappointed maybe once every number of years, just as a health check and stuff like that. And it also allows people to kind of reflect, and if they want to step off as a non-exec or as a director, that's up to themselves as well. But again, very clearly, as a company officer, you have a duty to keep adequate accounting records, prepare financial statements, that's the annual accounts, make sure that it's a true and fair version of that. And I'm guessing you know what that means, that it's up to date in terms of the specifications and the financial accounting, be it GAAP or whatever it is. And your obligation, depending on the size and scale of the organization, is to have it audited. There are exemptions for small companies, which a lot of people would take up. It depends on the category and the size. Certainly, once you get to a certain area, it's probably no harm. Turnover thresholds, once you go up over a certain turnover threshold, it's probably no harm to actually have them audited. But clearly, for the smaller ones, given the cost and so on, that doesn't make a lot of common sense. You have a duty on, I suppose, that whole piece about kind of disclosure of non-financial information, and that's the CSRD regs which have just come in. You have a duty to kind of maintain those registers and those other documents. You have a duty to file with the register of companies, those B10s. And I think we get asked this question a lot on a B10 because there is some confusion over it. You have 14 days from point of appointment to actually get the thing up into the register of companies. Now, it's all online, but a lot of entities come a cropper on that, and sometimes they get a slap on the wrist from the CRO. So their expectation is then within 14 days, just to be mindful of that. You have a duty of disclosure. If you see things going pear-shaped and are certainly illegal activities are occurring, you have a duty to disclose those. And you also have a duty to convene an annual general meeting of the company. In Irish kind of parlance, generally that's done with a 21-day notice period, but that can be shorter or longer. And there's some documentation around that as well. And again, most organizations over the last 36 months brought in a provision that AGMs can be done virtually. Now, the government brought in special regulation to actually cover everyone, and you'd be happy to know last September they extended that because it had come to the end of its special provision. That's been extended, and I think there's a Miscellaneous Provisions Act coming through that will actually make that just common law. So from a virtual point of view, you can hold those AGMs virtually, which has reduced a lot of wear and tear and carbon footprint as a consequence. It has been, I suppose, in the past, depending for PLCs, been seen as a bit of a blood sport, and you will have seen the banks particularly having cathartic experiences dealing with their AGMs, and they have been highly, combative with particular shareholders throwing shade and stuff like that. But AGMs are, they're a mandatory requirement, and I would always give good due attentions and diligence to them as areas of inflection points of potential disaster. So I would pay them due respect and have them and get them done and get them processed. On appointment, I suppose the vast majority of Irish companies, I suppose there are a substantial number of those organizations where the directors and members are one and the same, which is, I'm guessing, yourselves. So under such kind of circumstances, the distinction between the company's property and the member's own property can be a matter of some confusion. So I suppose from that perspective, you would have, where you see that kind of comes a cropper sometimes, is company cars. So it's, if guys are leaving or girls are leaving and stuff like that, that whole area, or laptops or whatever it is, just to have a good policy in place in terms of company property. It's not so much an issue anymore in terms of actual physical property, although sometimes you see companies hold property as part of their pension funds and stuff like that. But just to have a good policy in place there around that is no harm. But again, once you sign on to that letter that we spoke about earlier, or I spoke about, you should actually get a form out, and that form should say, for the avoidance of doubt, under Irish law, I acknowledge that as a director, I have legal duties and obligations imposed by the Companies Act, other statutes, and at common law. And that should be held by the company secretary in the file. And I'm guessing you all have done that, but if you haven't, probably no harm to get it done retrospectively. And that is a requirement under the Acts to have that actually in place. Okay. Excuse me. So fiduciary duties, I mentioned them earlier, and a director of a company, you have specific fiduciary duties to the company and the company alone. So to my mind, and I suppose a company director really stands in a special relationship to the company of which you're an officer, Pinnacle, I suppose, in this instance. And that special position is defined within law as a fiduciary position. And you as a director is known as a fiduciary. So I suppose where or however a director expressly undertakes that obligation to your shareholders or your stakeholders, that relationship is, I suppose, clearly defined as fiduciary under the acts and stuff like that. Now, this may be, I suppose, one that kind of goes back to the reasonable care. And again, from a law point of view, accountants generally are the ones that kind of are held to a higher threshold. But be advised that you have a duty of care. There is an expectation that you understand the documents that you're receiving. And that's why a lot of organizations, if, for example, the financial documents that are coming through, you see those courses, financial kind of courses for non-executive directors. They're there for that purpose, that you actually understand a balance sheet and have it explained clearly to you. So that's that fiduciary duty piece. I would say to you, and a lot of people fall into this category who aren't accountants, they mightn't necessarily understand clearly what those are and how those metrics work. If you are uncomfortable in that space, you also have within your right as a company director to get external training on that, as you are in this instance. But you are under law enabled to go within a reasonable quantum, go get some expert advice. So I often say to companies, no harm to actually do a training day or morning or whatever it is on spreadsheets or on the financial kind of accounts and stuff like that, so that people are comfortable, that they know what they're reading. So that they can fulfill their fiduciary duties. And again, it comes back to that point that they've all been encapsulated earlier as good faith, to act honestly in relation to the affairs of the company, that you don't exceed your affairs. And again, it's really about kind of just being aware of ethics and doing it in a probate fashion. And I suppose you can't benefit from or use the company's property or information or opportunities for your own personal benefit. And that's one where you see a lot of kind of issues arising. So, for example, a lot of boards now have moved their document suites to virtual platforms. And the reason for that is for security and integrity of documentation that's been shared and so on, because of, areas of leaks. And you often find it, for example, in the SEC in the States, where people are accused of insider trading. We haven't seen that much here in Ireland. It does occur on occasion, but insider trading would be a egregious breach of your fiduciary duties. And you see guys and people taken out in handcuffs in the States, the perp walk, as they famously say it. Haven't seen too much of it here, although it has occurred, and there has been issues of it. I think I'm trying to remember back, there was a couple of court cases back in the early noughties there was one particular case. I won't mention the particular individual because I think it's still slipping around 20 years later, where there was debate about kind of it. But there has been cases where people have breached fiduciary duties, and there has been kind of issues of insider trading. So just to be aware of that in terms of that. I'm not going to go down the rabbit hole here in terms of going right through it, but again, I'll send this out to you afterwards. You can take a look at it, but it just outlines your fiduciary duties. It comes back to exercising within your judgment the best interpretation of what your knowledge applies in terms of the set of circumstances that you're dealing with and the decisions that you're being asked to take. Now, moving on, I would say the next kind of area is that whole kind of piece around the board itself. Okay, so what I'm going to do is maybe talk you through the different dynamics and the different people on the board. So the first person is the chair, and heavy is the head that wears the crown. I don't know, do you have a nominated chair at the moment?
Probably all trying to get off mute. No, I think fair to say we don't.
Okay, so you have a collective chair, so it's a big crown that you're wearing. So probably no harm to have someone kind of, even if it's a rotational Taoiseach, probably no harm to have someone kind of considered as a chair. It is a defined kind of piece. And the chair ultimately is responsible for, I suppose, the stewardship of the board in your instance. And that can be, something that can be done on a 24-month or 36-month basis, but it is kind of that piece as well, that the chair is often the person that speaks for the board. If, that there's a totem pole there. The managing director and the chair cannot be the same person, by the way. They have to be separate, just for the avoidance of doubt. And that kind of has been brought in over the years as a consequence of many of the disasters that occurred in the financial area over the years, where Anglo is a case in point. Where the managing director became the chair and vice versa. And so there is that kind of separation of church and state there. So ultimately, the chair is expected to, as we've laid out here, ensure the board's effectiveness in all aspects of its role. And it's about efficiency. And what I would say about the chair, sometimes people kind of get mixed up about the chair. The chair's job really is to drive the meeting. Okay, it's not necessarily, you don't necessarily have to have strong opinions, but you do have to have the skill set to actually get the meeting, run it through, and make sure that it's delivered on time and that you get through the agenda. So that actually is a skill in of itself. And the chair needs to be diplomatic as well, that they actually get everyone to speak, but actually can also harvest those that are a little bit more reluctant or reticent and get their share of opinions kind of harvested from them as well. So again, it is important to have someone, whoever that person is, and maybe for yourselves, it might be that you do a recurring or rotating chair or whatever it is, but it is important to have someone. And again, I suppose the delegation of authority flows from the chair, from the board, and that delegation of authority piece really is what you delegate to the I suppose the board members down there. So you're kind of a little bit different insofar as you will delegate authority to the managing director, in this instance, for example, or as an example, and that would be, you would have a number of delegated authorities. That often goes back to check signing or something as simple as that, so that the managing director or the company accountant would have authority to sign up to a certain threshold. And if it goes beyond that, it goes to the board for sanction, or you may have a protocol that 2 directors have to sign off once it goes over 500,000 or a million or whatever your 5,000, whatever the quantum is. But most entities would have a delegated list of authorities that they would delegate out to specific people within the organization. And conversely, they would also have matters referred to the board that is exclusively for yourself to decide. The one that most people would be familiar with, and that is the hiring and firing of the CEO. So that's a matter reserved on the board, reserved matters for the board. So what I would say about delegation, just as a takeaway, is delegation does not grant absolution. You are still, as the board director, is accountable for everything that goes on. Heavy is the head that wears the crown. So while you can delegate, you can't absolve yourself from the decisions that are made by the delegated person. So that's that point about making sure that you're getting regular reports and stuff like that in terms of what activities are taking place. It really kind of falls down to kind of the managing director, and the financial director generally is where the delegations fall. And there's about 15 of them, where we would see is about the number we would see in that space. But they are required to be reviewed on an annual rolling basis. Because, as I say, companies can get bigger, can get busier, and the quantum can actually increase or decrease. So it's a good habit to actually look at those policies on an annual basis and review them. I mentioned the secretary a little bit earlier. Secretary is a specific role under the law, and they're there to carry out the instruction of the company directors. Now, you can have a secretary, which is not unstandard, and indeed can become common practice along a lot of smaller companies, that the company secretary would also be a member of the board, and that's fine. But it's a defined role. A lot of entities then equally would outsource that to their accountants or whatever, or it might be it often falls to the financial director to be the company secretary as well. But that person, whoever that is, or the entity, if it's a third party, they're there to ensure that the company obeys both the law, the rules, and its constitution, and more importantly, is there to assist you with the preparation and maintenance of your legal documents, such as making sure that the minutes are recorded and they get out, that your annual kind of returns are going in on a regular basis, and the various bits of paperwork, B10s or whatever, are up to date and up to speed. So whoever that person is or that entity, they are appointed, you are aware of who they are, and that they are sufficiently resourced to get the job done on a timely basis. Again, the secretary, I suppose, maintains the register of interests. That's that specific person. They are, by definition, it's a very confidential space. They hear a lot, they see a lot, and they actually retain a lot. But they are often the conduit between the chair, if you will. It's kind of a second kind of gap, or second kind of line of communication. Sometimes people might be a bit uncomfortable bringing something to a chair of an organization, whereas they go to the company secretary, have a cup of coffee or a cup of tea, and say, "Look, I'm a bit concerned about this. I'd like it aired," or I'd like. Where you often see it finding its expression would be if they want an item brought onto the agenda. So they go to the secretary or indeed the chair and say, "Look, I want this item brought up on the agenda and included." And that's, the secretary generally prepares the agenda, and the agenda then is confirmed with the chair, and people kind of can engage in advance with that, and that's how that communication process. But that person or that entity, whoever it is, needs to be up to date in terms of your own internal rules and the external legal responsibilities, and keep abreast of them. And as I say, just for the avoidance of doubt, it's about kind of making sure that BTINs are in within those 14 days. Equally, just to be mindful that if, where I've seen it recently, if a director becomes disqualified under the law of another state, for example, in the UK, this is deemed to be a change amongst the directors, and accordingly, the company secretary must notify the register of companies in Ireland of the jurisdiction where it happened, if it's the UK or America or whatever, where that disqualification became live, or the date it became disqualified, and the duration of disqualification imposed. There has been some significant slaps on the risk to entities in the last 6 months where, and they actually weren't aware of it themselves, where one of their non-executive directors had been disqualified in another jurisdiction, hadn't actually brought it up. It became aware, and someone whistleblowed to the CRO, and fines were imposed. So again, just to be aware of the rules of engagement. There are rules, they're laid down, there are formal kind of requirements. And as I say, if you are appointing someone internally, if it's a busy organization, that they need to be professional and mindful of their business. And there is a requirement that if you're a company secretary, you're fit for purpose and have some qualifications, depending on the size and scale of the organization, or that you are a suitable person as considered by the Minister for Finance, as a case in point as well. There's three qualifications. One is a membership of a particular company secretary's body. Second is that you are suitably you have 3 years practice in the company, that you know what it's about, or thirdly, that you are considered fit by the minister. So, just to be aware of that as well. Excuse me. I'm going to talk a little bit about induction, because it's important about setting yourself up for success. And really, I mentioned it a bit earlier, but where a lot of companies come a cropper is in the whole area of setting people up at the get-go. And really, that should kind of start in a phased basis. And I would step back from it at one point. No harm for you kind of once a year to have a subcommittee that just has a look at, the rotation. So if people are coming up for retirement, or people have flagged that they're stepping off, or whatever it is, that you have a kind of a discipline in place for rotation, and maybe just do a bit of scanning out there as who's the next natural successor, or have those conversations, so that the board is kind of tooled up in advance of any movement, as you've done recently for clearly, which is good. But that will naturally occur again. So it's good to maybe just have an annual meeting just to have a look at rotation and succession planning. And we would often kind of use the word sustainability here. It's about board sustainability, not necessarily planet sustainability. So again, once that kind of conversation has taken place with the chair, with the nominee, and they've accepted and they've done their due diligence, and I would always say to any of you, if you're joining a board, do your due diligence. Ask a few questions, make sure that the people that you're joining are probate, that you're happy to work with them and stuff like that. It's good practice, regardless of whatever board you're going on to. So I mean, you then get your letter of appointment. That's a standard letter that lay out your terms and conditions, how long you're going to be in service for, whatever it is. And you'll have a standard letter there to each individual entity. They'll have their own letter, and they'll have their own terms and so on, and what the expectation is. You should get, ideally, and that's what I see a lot of entities do, is they have that board member handbook and role description, and that kind of defines basically that corporate governance manual. It encompasses everything that we've just done, and to do, for example, and it gives kind of a blow-by-blow account in terms of how we do things around here. And it also gives some flow charts in terms of the business, if they're not, for example, kind of embedded in the business as a non-executive director coming in. It also gives you a line of codes of conduct, who the current directors are, when they started, and other details about that. Some, for example, would publish, for example, email addresses and stuff like that, so that people can communicate, contingent on GDPR regulations and so on. One thing I would say to you, again, for certainly medium-sized, not so necessary with smaller ones anymore, but sure that your D&O insurance is in place, directors and officers liability insurance is in place. Good thing to check on. And one of the things we see a lot of entities now is including in that cyber insurance, cyber risk insurance, which has got a little bit more expensive over the last 12 months. So we're seeing that as an adjunct element to the D&O policy. And I would actually say to you as a rolling agenda item once a year to actually put in as a rolling agenda item the D&O, make sure that it's up to date. And for example, as I say, if you need cyber insurance for yourselves, put that in as well and satisfy yourselves that the quantums are sufficient onto your needs. In any event, a lot of contracts requiring RFQs and stuff like that require cyber insurance. I know moving forward, certainly in the last 6 months, we're seeing it ourselves, even in our area, a requirement for cyber insurance, which is interesting. A board pack at the last meeting, you know, the financials and stuff like that are always good, and the board's term of reference. So, for example, a board should have a term of reference that kind of lays out what we've been talking about and what you're doing. But equally, if you have subcommittees, that they should have terms of reference as well. I don't know, guys, if you have any subcommittees, but I would suggest if you don't, maybe an audit and risk committee is a good thing to think about for someone like yourselves. Just that, you know, I don't know. I'm saying I'm taking a wild stab here, and you're going to have maybe 6 board meetings a year. Maybe not, maybe 8, but maybe 6. And within that context, maybe having 2 audit and risks interim wise would be a good thing, just to keep an eye on the finances and stuff like that. And equally to give you some insurance and risk mitigation. It's kind of like an insurance policy. I always think for smaller entities that boards are busy, that the ARC comes together, throws their eyes over the figure between the board meetings, and it kind of gives you that framework of security that you're just going to a bit of a deeper level that you mightn't get the opportunity to do so in a regular board meeting. No harm to do. Hot tip encompassing all that is, I suppose, that whole kind of piece of transparency. And again, it's really about kind of one sees, they all see. And I think if you look at a lot of the issues that have arisen, it's because people were, you know, using opaque terminology, or they just weren't being forthright with the situation, the as-is situation. They weren't being kind of very straight, and they steered into the iceberg. So again, as I say, transparency is the order of the day. If you hear something that's pertinent to the organization, let your colleagues know as early as possible. And, you know, as I said earlier, unlike wine, bad news doesn't get better with time. So a general kind of thing about kind of, I suppose, board composition and structure. And it's to that piece about skill sets and competencies. Every now and then, you know, look within yourselves, look around the table, and just make sure that you have the right kind of balance at the board. Or if there's a huge gap, okay, in your skills, maybe look to consider appointing a non-executive or something like that. There's nothing wrong with that, you know. And the non-executive piece goes to that terms of reference very clearly. They're appointed for a particular time, particular role, particular skill set. They're not generally shareholders in the organization, so they have no fiduciary exposure or skin in the game from your perspective as well. But they bring an independent, I suppose, point of view to the board as well, which can be helpful. Food for thought, worth considering, depending on where you're at on your journey. You are required within kind of the various acts and stuff like that to have a strategic plan in place, okay, so that you have you know, that can be 1 page, it can be 20 pages, but just to be aware that you have a requirement to have a strategic plan in place. And I would say, at the moment, 3 years is about right. And really kind of, I suppose, it's that piece about kind of looking, you're all familiar with strategic plans, but no harm to actually, do you have a strategic plan, case in point, can I ask?
Again, I'd say, sorry, maybe get off mute quicker. Unless anyone else has got a view of it, I haven't. So I don't think we've probably had some conversations about it, about strategy, and we've had a number of meetings about what the future looks like, etc. But I think it's in a written down plan. I don't think we do, unless Emer, Marita, you guys have seen anything else or have anything else that I haven't seen or there.
No, nothing formally documented, definitely not. No.
So what I would say to you is, as an observation, take a half day sometime. Okay, go off outside Dublin or wherever. Paul, you could actually, enable Ryanair and hop on the bus and come over, or vice versa. But it's actually quite a good thing for busy organizations such as yourselves, where you're actually tactical the whole time. You're dealing with really a very, very busy space with a lot of stuff coming at you, to actually step back and have a think about the organization in terms of the next 5, 10 years or whatever. So a strategic plan, as I say, it doesn't have to be a big thing. It can be done in a half day. And there's loads of, and bringing an external facilitator to do that for you. But it can be very healthy and it can throw up a lot of stuff, and it can be really helpful and powerful as a tool for yourselves to actually just, every organization needs to recalibrate, and particularly busy ones, because you can be so busy on the day-to-day stuff and fulfilling contract and obligations and stuff like that, that you just don't have the opportunity unless you lay in that discipline to step back. So I would say probably as another consideration for you guys to think about over the next 6 months, 12 months, is think about maybe just taking an away day or something like that, or an away weekend, and go off for a weekend, play golf, whatever it is, but set aside the Saturday morning and do a strategic plan, break bread afterwards. And you could find it very helpful. I've yet to see a board that hasn't come back refreshed and just refocused and has a very good commercial outcome in terms of that kind of discipline. So food for thought as well. I won't belabor the point. But as the discipline of that actually kind of flows, the tip here is that the board then should, if they have that overarching plan in place, I mean, you can't actually know where you're going if you don't have a roadmap to navigate your way there. So I would say that when you have that roadmap kind of clear in your mind, and you probably kind of very much know it in kind of essence, but you just haven't kind of codified it. It's to have that piece of 25% is looking at KPIs in terms of last month and what went on, and 80% moving forward. As I said, I've never seen that actually in place. It's probably more 50-50, but just to get that balance right, because if you have that strategic plan in place, you can work towards it, and you can actually kind of, you're in the foothills of the Himalayas, but you can see the progress, and you can see kind of where you want to go, and if whatever the plan is, but at least you have an agreed structure. And the general point where we find that happening is where there's new board directors coming in. That's a perfect time just to relook and kind of refresh the kind of the team's view in terms of making sure that everyone's collectively bought into the vision and the mission, and everyone knows what's expected and where you're going. So that's a natural time when there's new directors coming in within that 12-24 month period. Performance oversight. It's very much about that in terms of what you're at. You're looking at the organization in its broad context, the employees and stuff like that, making sure that there's I suppose, a discipline of performance oversight, and that you're asking questions. And again, it's that piece about asking questions and constructive challenge. So I would say the point there is nose in and fingers out. It's as a board, and it's difficult for yourselves, okay? But if it was a more general board and you were non-executive directors on a board, it's just nosing in, but keeping your fingers out. So you have the executive teams and the guys that are working for you doing the day-to-day stuff. And again, it's difficult for yourselves because you're actually both. So it goes back to that point I would say to you is just be mindful of that separation of church and state in terms of just having that discipline of being a board when you're a board, and being management when you're being management. And it is hard to get your head around, but there has to be a clear break psychologically for yourselves that that, okay, we're in on the board today, the minutes are being taken. It's a separate kind of task we have in terms of how we go about our business. So I would say to you, just again, just try and kind of embrace that discipline, that the board is the board, that time is board time. The rest of it is tactical, it's the day-to-day stuff. But just set that time aside and think a little bit differently and think a little bit more longer term. Culture is a huge issue at the moment in all boards, regardless of size, scale, whatever. And it's kind of that piece. I'm not going to go into it in too much detail, but if you look about it, they used to call it board dynamics. It's now very much about culture and behavior and EDI, and that whole kind of I suppose expression of getting as much intellectual horsepower onto the board as possible. I leave these up until I use a C methodology myself just to remember them. There's many different ones out there, but I look at it in terms of, I suppose, that 4 points about the technical capacity you have, and you'd be more than kind of capable, I guess, in the IT space and stuff like that. So you have capability, you're connected, you have sufficient capacity. You're certainly kind of, from a board point of view, you're configured, you're stood up, you're hopefully compliant, and you have structures in place that your accountants ensure that. As individuals, that you're competent in terms of your business affairs, you're committed to the board and the organization, the company, and you have good character. That's important as well, that you're probate. And again, that culture piece is the cohesion, the glue that holds you all together, and that you have confidence to actually ask challenging questions. And that's a big issue where a lot of boards, particularly for new members coming in, feel that they mightn't necessarily have the confidence at the first kind of They don't want to be sticking their hand up and asking what they may see as stupid questions or whatever, or they don't have the that kind of respect around the board table that they're going to ask. And we regularly see where boards get captured. They're just not asking those questions on occasion in terms of, I suppose, new people coming in. So it is important, I suppose, to have that confidence. And you get that sense that it's an open board. Questions are, freely encouraged, that the chair is encouraging people to ask questions, and he or she will do a quick round robin and say, everyone comfortable with that? Are we all squared away? And move on to the next section. So it is a little bit about that as well. And again, we break down boards in different kind of categories. So what we see as an ideal sort of board is that it's inquisitive. It is asking questions, it's looking to the future, it's open to new ideas, it's decisive, it is actually focused on the mission, it's actually generating KPIs and it's driving towards them, and it has outcomes and an orientation in terms of the decisions that ultimately are going to be done, and they're recorded and they're rolling and people are kind of being held to account to that. It's collaborative. So as a team, you're pulling together. That's really important. And you can only do that by coming together, breaking bread, having a cup of coffee, sitting around the table, getting a sense of the as is, and that you're disciplined, so that when you're at the table, you're fully there. You're not separated. You're not, double or triple jobbing, which can be challenging in a Zoom environment. But when you're there, you're present. So that, from our perspective, when we look at it and we do a lot of culture audits and stuff like that, that's really what it looks like for us when we break it down. Now, we can give you a 200-page document on culture, but if I'm being brutally frank, that's that's what it boils down to. And again, you can ask yourself a couple of questions. I mean, do we have the right people in the boardroom? Are we structuring our time and our discussions appropriately? Are we focusing our time on the right discussions at the board when we're there? Are we operating as a team? And are the individuals asking, the best questions that you would expect from them, from their independent thought? So those are the sort of questions that you can ask yourself. And I think most boards can probably pick that up and kind of say yay to a lot of them. Where you have problems of cultures, where you have an individual that has a hidden agenda or an overt agenda, and they spend an awful lot of time just pushing this parochial agenda to the toxic outcome of the board, and you get a lot of, it's always down to personalities at the end of the day, people falling out over different views. And I suppose a mature board will have the maturity to actually accept that you might not necessarily agree with each other, but you respect each other enough professionally to actually come collectively together and make the decision. And that's the key point. It's not really good as well from a board perspective that boards go to votes. Rarely see votes on boards, to be honest with you. And occasionally you will see a board going to a vote in a particular thing, but that's not a healthy thing to see votes being taken at every board meeting. That would be the exception to the rule. So I wouldn't expect yourselves to be voting on every decision that you made. It's a collegiate, collective endeavor, and you just crack on and get it done. Just put that up for when you're looking at this afterwards, just again, from a Pinnacle point of view, it's that kind of flexibility, collective effort, stability, and individual expertise. And I wouldn't discount stability as at the core. It's very important to have a strong, stable core. And again, from a corporate governance point of view, it's having that balance of people that have been there for a while, new people that are coming in, transitioning people, and so on. So it's that stability, what we would sometimes hear corporate memory. So boards need to have a degree of corporate memory as well. So that one of the issues, for example, with boards is that you have everyone appointed for 5 years and they all fall off a cliff face at 5 years and the board collapses, and then you're left with a new board coming in. There's no frame of reference, there's no corporate memory. So just kind of to stitch that in as well. To that point about strategy, equally, it's probably no harm. It's a harm as opposed to harm. As it was expressed there recently at a board meeting, harm to have a vision expressed. They're quite popular. I don't necessarily think they have to be that big, but it's that vision and values, and it goes back to the strategy piece. But you're going to have a vision yourselves. You just maybe haven't expressed it, and you do have values. You all will have collective values. I'm guessing you probably, your values is that you are efficient, effective, you're professional, you deliver on time, you have trusted relationships, relationship matters, whatever they are. But that kind of a way there, if you decide to do it, it's actually a nice thing, a healthy thing to actually, enunciate what matters for you as a board. What are your values? So, where that kind of, I suppose, adds some value to you, if I can give you some kind of confidence on it, is employees. We're at full employment at the moment, and then probably in the top 2 or 3 things, kind of concerns we see on smaller boards, and all boards indeed, is retention. It's a huge issue, retention at the moment, and getting people to come in. So anything that can add value in that space from a recruitment point of view, to actually have those values espoused when people are looking at your shop window in terms of your board, for example, or in terms of your website, to have those values, it immediately kind of gives that sense as, oh yeah, okay, those are the sort of guys I wouldn't mind working for. And you have them yourselves anyways, and it probably is a nice place to work, one would hope. But when people are looking in at the website or looking in at your documents, that you can actually say, well, these are our values. This is what matters to us. And when you work for us, this is what you can expect. And this is the sort of team environment. So whatever they are, I would say for no other reason other than being parochial on retention, it's no harm to have those values on a menu on your website. And I would say that just as a really practical tip in the brutal environment of retention that we're in. All organizations we're dealing with are really struggling to retain people. You can get people the last 36 months and they bugger off to Australia and New Zealand. That's just on the professional side, it seems to be a whole scale intergenerational kind of heave between the ages of maybe 25 and 35 are all going out there. So any hope you have or any added value you can offer in that space is really important. Okay, board meetings. What I want to talk to you about is efficacy and what good looks like. So I would say 2.5 hours about right, maybe 3 hours. All right. You're going to have to get those board meeting agenda out in advance. Board papers need to be out a week in advance. You need to be as clear as possible in terms of what is the output, what you're looking for in terms of decisions. What we see with boards like yourselves sometimes is that they will have papers for noting and papers for decision. So that actually kind of cuts to the chase very quickly. So that's clear, informed, and you'll have a rolling agenda item in terms of key actions from the previous meeting. You may already have all this in place, but it's just a discipline in having it done so that people can refresh themselves when they're looking at it as they're moving on. And again, attendance is important. Really, if you're signing on as a director of a company, it's expected that you attend. It's not really good enough to be pedestrian and kind of tugging out intermittently. If you're on deck, you're on deck. Be on deck and be there and give it due attendance and due skill. As I said, you are a board director 24/7, 365 once you sign the B10, so you may as well attend. And again, on AOB, I would take it at the beginning. It shouldn't be there for landmines and kind of, scuds and conflicts of interest. I think it's healthy, as I would say to you, to do it on a not irregular basis to show that they're there. What that might look like in terms of an actual agenda. So you have your welcome and your apologies, declarations, and so on. Approval of previous minutes, if that's the way you roll. Generally, you can do it as a proposer or a seconder, just as a general acclamation, just rock and roll through there. Activities report, whatever that may be. Schedule policy updates for approval, important. Because there are kind of policy updates the whole time coming through, and just to be aware of what they are. Review of meeting and diary of meeting. That's actually sufficient as an agenda. It gives you enough flexibility. You may have specific items within that you have recurring, or you want to drop in on a regular basis, an update and so on. Try to avoid groupthink, guys. Difficult, particularly when you're all working together. Of course, that independence of thought piece. It's important as well, just for the chair to ask, is there a devil's advocate here? Is there another way that we need to look at this, just to tease it out that we've considered every option, so that whoever that person is. Sometimes I see chairs actually appoint someone as devil's advocate for the meeting, and that rolls around the table, and that can be healthy as well, just to give a second perspective, so that their specific mission at the meeting is to ask those awkward questions and whatever. That's fine. And it's there to drive participation. It is important that everyone kind of speaks up. It's not good enough just to be there silent, never speaking. It is important to kind of be heard, maybe not on every meeting. And it's, as I said earlier, you don't have to have an opinion on everything, but you are there for a purpose. You're there because people value your opinion and that you have weight and intellectual weight. And from that perspective, you need to share it on a regular basis. The chair needs to watch the body language as well. I know it's a small thing, but just keep an eye on that. If people are fidgety or they need to kind of leave early or whatever it is, just keep scanning the room. And it's important that the chair kind of harvests. And as I said, if you appoint a rolling chair, maybe that's the way to do it. I don't know. It's up to yourselves. And it may be working very efficiently, but it would be unusual that someone doesn't lead meetings, be they designated as chair or not. Someone has to keep the agenda rolling, I'm guessing, by definition. So I guess, you know, and that the chair really kind of manages, I suppose, people who might be unprepared or who repeat themselves ad nauseum or are focused on their own agendas. So it's that kind of person we all know who takes up and soaks up all the oxygen in the room. And, you know, you just need that diplomatic touch to gently guide them towards kind of the seat and allow other people to talk and share their views as well. So when we look at board effectiveness, you're looking at maybe, I think myself, this is my own personal view, and I've said 80-20 is the academic kind of perfect world, or the CRO perfect world. I think strategy, you'd be doing well to spend 50% of your time on strategy. Compliance, always have compliance, because there's always kind of, as Albert Reynolds would say, it's the little things that trip you up. Make sure that your paperwork is up to order. So that, you know, 10% in compliance. Finances should be around 10%, you know, get it done and dusted. And if you have an ARC in place as well, that helps to break that down for you. Operation should be about 20%. Now, you know, for yourselves, you're an operation, you're a tactical board, that, you know, those metrics can change. And those are the things that kind of have come up you need to deal with, you know, 10%. But that's kind of an example of what your time might be over the 2.5-3 hour space. But again, you'll notice strategy, and that's that definition of the difference between when you're having a board meeting as opposed to your senior leadership team meeting. And that's that difference of thinking when you're at that level. One of the huge issues that you're going to have to deal with is risk oversight, okay? And again, can I ask you to come off mic, do you have a risk register?
No,
No?
Oh,
Okay.
In our heads, Pat, probably.
yeah,
Yeah.
we've discussed the risks, but yeah, we need to get them into registry, yeah.
So before you get hit by a bus, okay, is there a folder someone can go to the next layer down from you that can keep the company going for a week? That's what I would say about the risk register sometimes. It's good to just have that go-to folder in terms of business continuity planning. Invariably, we actually, one of my colleagues, that's what he does with business continuity plans, and he will put his hand up and say, you know, he had, you know, planes falling out of skies, terrorist attacks, trains crashing in Kerry, you know, ships sinking in the Gulf, and all those variables. Not once in all the hundreds of business continuity plans he's done had he put up pandemic, you know, and it came and bit him. So a lot of companies now have done a business continuity plan, which kind of is a segue for a risk register. But I think as a discipline, guys, you know, as something to do, and I'm not imposing work on you, but you should probably have a risk register. Whatever about the risk appetite statement, or, you know, the risk policy. Risk policy is probably not a bad thing for the avoidance of doubt that your employees can have a look at in terms of what you see as your risk policy. You know, every organization has to have a little bit of risk appetite. Chips were not built to stay in port. You have to go out onto the corporate sea and endeavor to, you know, engage. But sometimes there's no harm to actually look at it. So your risk register, you know, whatever that could be, you're aware of what your risks are. I mean, client retention could be a big one. You know, contract rollover might be a big, whatever it is, IT failure. There's all variables, but you probably should have maybe 10 risks, and probably 10 risks is enough.
The gas thing is, Pat, we deal with risk registers every day of our lives for projects.
Yeah,
you know, so it's something we manage all the time for our clients, business continuity, all of this stuff. We know how to do it, and we do it for others, but it's like the cobbler's children, you know.
Yeah, I was just thinking that, and that's the classic example.
Yeah.
Day-to-day stuff that you actually live, breathe. It's part of your
Yeah.
DNA, but the cobbler's children are always the worst shod. So
Yeah.
no harm, and actually, it's actually cathartic to actually do it for yourselves, because it'll actually, for once, have actual meaning over and above a third party that you're providing the service for. It's a whole different experience when you're looking at your own livelihood from a risk perspective. So again, you know, not imposing work, but no harm to actually do a quick exercise there and do
Yeah,
it
no,
once a year.
definitely. Yeah. We're planning again, you know, a face-to-face meeting, you know, and I'm kind of just jotting down the agenda here. I'm sure everybody else is. I think there's a lot of stuff we can address in our, you know, our next meeting.
And it is about efficacy and using your time. So,
Yeah.
but those basic building blocks, and you know, another thing, just for no other reason, I would say this to other organizations, not yourselves, but if, for example, you know, in 20 years time, you're looking to maybe sell the company or something like that. One of the things, you know, we see it on the other side when we're tasked by companies to have a look at it. One of the things they always look for is a risk register. The number one thing they will look for in terms of their document suite, they look for a risk register. So if, you know,
I think
just
the other side of the other side of that, Pat, is, and we're increasingly seeming to see it, no more than the ESG stuff. You know, there's expectations from people that you do business with. They're continually pushing down and saying, you know, they want to push more back into our organization to see that we're structured correctly to do business with them. So they, you know, that, you know, it's the sort of thing I could see coming in. The bank is constantly updating its master service standards, template master service agreements to push more, you know, onto ourselves to evidence that we're doing in this corporate governance space.
Yeah.
So, you know, I wouldn't be surprised, but, you know, in a year or two's time, the next level of the template will say, show us your risk policy, show us that you've got our evidence that you've got a risk register in place, etc., that you're actively managing. You know, you could see all that coming down the track. So,
Yeah.
And John, have you got any requests in for CSRD compliance yet?
I'm not even sure what CSRD stands for, Pat, right?
It stands for Corporate Social Responsibility Directive, and it came into force on January.
I don't think we've seen any specific requests, but what we have seen in the latest version of the, so I'm in the Bank of Ireland, and you know, we update the master services agreement probably it's getting more frequent. It's probably every 2 years now, and you can see that sort of stuff. They're probably ahead of the curve in terms of all this stuff. In terms that there's probably more in their master services agreement that you're expected to live up to than the directives will have, if you see what I mean. So we're constantly being expected to live up to that level of standard, if you like, and to evidence that we live up to that standard. And, you know, things like that you know, I'd be surprised that they won't ask in future, Pat, that you can evidence that this sort of training has happened for directors, you know, and this, it's all about evidence, prove that you're that you're not that just you know, they can see we're capable, but it's proved that we've got the controls in place to make sure that nothing falls through the cracks. I don't know if that's answering your question, but that's
no, it is. And but I would specifically say to you, and I happen to know Bank of Ireland specifically on this issue as well, and AIB, they are under the CSRD regs and the Corporate Social Responsibility Directive. They are obliged, okay, now to engage with third-party providers and get data from them in terms of input. So I would, and that became law in January, and they're going to have to report on this year. So I would, if they haven't already, it would be no harm, I would say, to whoever your auditors or whatever it is,
making sure that we've got all that in place.
Just maybe just to ask them what sort of data harvest should we look to, kind of, because they'll hit you probably mid-year with a weaponized kind of request for all this kind of data, and it's going to be crucifixion. And there's a tsunami going on there at the moment in that particular space for third-party providers, and it's really about kind of and you're going to push it out to, it'll be down, you know, down to
we'll have to push out jars and all the rest.
All of that, yeah.
How far back does it go?
Yeah, I know, and it's a pain in the keister, but it's what'll happen is it'll become suddenly, and it'll become very urgent very suddenly. So what we're saying to, you know, entities like yourself, which fall into the third party category, is try and start mapping out kind of that data which you have and capturing it now. And the easiest thing to do as for yourselves would be to ask your accountants, or if you have a friendly person inside in Bank of Ireland, what sort of data would they be expecting to get from you so that you can start configuring it? Because they will 100% come at you and look for it. And it's probably the busiest area we have at the moment is CSRD kind of training and that sort of area for entities such as yourselves and so on. But I'm not suggesting you do training on it, but I would suggest that you might have a quiet word with someone in there in terms of what their expectation would be, just to get ahead of the curve.
I'd have to look back. Sorry.
It's no big deal if you can actually break it down. It's like eating the elephant and just start. You have the data. It's just a matter of putting in a process to capture it. That's all.
Yeah. I'd
But
have to
anyway,
look back at I'd have to look back at the MSA, but I'm pretty sure, Pat, I wouldn't be surprised if I look back. There isn't even a section on corporate social responsibility and what our obligations are, what their expectations are. So, you know, they're getting they're very quickly coming up the maturity curve on that. Yeah, definitely. Yeah.
so what will be in your last one will be NFRD, which is the Non-Financial Reporting Directive. That will be in it. So the EU morphed that and gave it kind of horsepower, and it became the CSRD. They love the TLAs, like NASA, three-letter abbreviations. So it's now become the CSRD, and it's got teeth, and there's big fines, and they're just dying to impose a few fines. So everyone's kind of, you know, sitting up and begging for mercy. But anyways, look, just be aware
Yeah,
that
thanks for that.
Yeah.
Yeah, thank you. Yeah.
risk is fine. Look, I'm not going to teach you to suck eggs. You're doing it on a daily basis. You know better than I. But I would just say to you as a central guidance, maybe just get those three pieces in place. Maybe just a basic, you know, risk appetite policy. No harm to do it. Get up a basic risk register. You guys could do it in half an hour, I'm sure. You know, it's meat and veg to you. And then maybe just on a biannual basis, just have a look at it. But again, the discipline I would say to you is just take one of those risks. I get one of you guys to pick one as a risk owner and just do a deeper dive so that everyone's aware. Because you'll all have parochial silos that you specifically look at in the risk, and you are subject matter experts in it, but your colleagues mightn't be as deeply ingrained in it. So no harm to just do that as a discipline. What we see ourselves, and we go back in terms of themes that we see emerging kind of from risk is that kind of ineffective boards that people basically use an awful lot of time talking crap, and they're not actually kind of getting meaningful engagement, and they're talking about the football match or the whatever it is, and they're just not focusing on the actual mission at hand. So it's ineffective boards. So, you know, that 2.5 hours, crack on, get absolutely through it and get the agenda covered and done and dusted. There's nothing as attractive to people on boards as actually using their time efficiently. Board minutes, be efficient, you know, be practical about your board. Don't ever actually as well reference an individual on a board minute, just, you know, as a hot tip as well. They are legal documents, so never refer to an individual unless that individual expressly wishes to be minuted as recusing themselves or, you know, making a point that they were against a particular decision. So, no evidence of robust scrutiny is something that the CRO comes back in, that when they looked at the minutes, no one was asking any questions. There was no scrutiny on the decision that was made. And you would have seen that with RTE. That's the thing that comes back. No evidence of robust scrutiny. Comes up time over time over time. Absence of necessary skills, that competency piece. Weak financial reporting process on the bigger boards for some obscure reason, particularly in the colleges, is coming up. And that's GAP is going to take care of a lot of that anyways when it comes in as an accounting standard. And culture. And again, that's where you had a kitchen cabinet directing everything, and you had silos, and you know it was preordained that the chair and the managing director had it all decided before they ever come into the room. So it was preordained. Again, I would say about the ARC, if you have an ARC, probably no harm to think about it, okay, and meet twice a year and just do a deeper dive into the finances. There are a couple of questions you can ask, which are common to the board and common to the ARC in terms of basically have you got the right people. And actually, one of the things about an ARC is you can get someone external on the ARC, okay, so you can appoint an external subject matter expert, you know, a chartered accountant or something like that, that will give you a real independent kind of view of your figures. Pay them a couple of quid and Bob's your uncle. Is probably the best money you'll spend, is having that third party assurance of an independent external. Food for thought.
Can I just ask a question on that, Pat?
Yeah.
So on an audit and risk committee, what's the auditing? Is it auditing the effectiveness of the board? Is it auditing the audit of the accounts? What is it?
It's purely to do with the audited accounts and the accounts and the finances. So they're purely focused. Now, you'll have a terms of reference. So for someone like yourselves, the ARC might be, the Audit and Risk Committee might also include governance, for example.
Yeah. Okay.
It might include risk, you know, it's audit and risk, but it might include governance and nominations. You don't need 4 or 5 subcommittees, to be honest with you. You probably just need one.
Yeah.
And that could encompass governance, which covers compliance. But it is an opportunity for you as well. If you wanted to, if you knew someone that was purely, had no skin in the game for yourselves, it gives you that assurance that you appoint someone, pay them a couple of quid for sure, for the 2 or 3 meetings that they come to. But they are absolutely, you all trust them to have no skin in the game. They're independent. They will ask those kind of questions that might seem obvious to yourselves, but aren't really obvious. So that's where the value is. You don't have to, but
You know, so yeah, that's
to
good.
indicate that it's probably no harm to do that, you know.
What's the typical pay scales, Patrick, for that type of resource role?
Well, you know, a couple of Ord Cordia tickets wouldn't go straight to Emer, you know. For an ARC role, for someone like yourselves, so I'll give you an example. So the going rate for a director of a small company in Ireland at the moment is about 25 to 35K for about 6 meetings a year. Okay, that's for a main board director. For an audit and risk committee meeting twice a year, I would probably template it maybe around, you know, 5 to 7.5K. But you know, there'll be a standard range. You know, you have to make it kind of interesting. You don't want to be kind of mealy-mouthed about it as well, but you don't want to get absolutely screwed in terms of it. It's not AIB, you know. I mean, an AIB director should expect about 50 to 250K, depending on what their scope is. But that's so again, you know, there's a value to it, but you will define what that value is. Okay. But again, if you look at the, you know, if once you think about it, I suppose in tandem with, they're going to be taxed on that. So there should be a day at the Galway races in it, at least, you would think, you know.
Yeah, thanks
Bad
for
analogy
that.
to use in terms of corporate governance, but anyways. So food for thought. I'm just giving you food for thought on that one.
Yeah.
You know the different kind of metrics in terms of risk categories, but the one that everyone sits up at when they're falling asleep at this stage of the session is the last one, is reputational. You know, I often say corporate governance, really, those books that we write and stuff like that we offer them as well from a medicinal point of view for hardcore insomniacs. So, you know, it's certainly kind of not an area that people are very excited about. But reputational risk is the one area where everyone sits up and begs for mercy, because it's the one area that concerns everyone. Make no mistake, it is got very, very challenging out there. And you've seen, you know, in the media, how brutal and how quickly that can escalate. And we'll use some examples in a couple of seconds. But that reputational risk, always be aware of it. When you're on a board, you're legally exposed. Okay, there is no ignorance, is no defense. So just to be always mindful of that. So again, I'm not going to go through a step process for risk mitigation. You guys, you know, could write the book yourselves. I would suggest, you know, again, in terms of those matrices, because something as simple as that can work. You know, but you're doing them yourselves day in, day out. I don't need to kind of go through that. But when we come back to reputational risk, so if I was to put up this, all of you are aware of that, aren't you? Pretty much, you know, from a reputational point of view, the damage. And in fact, people lost their lives on that one. You know, that individual there, you know, passed by his own hand. It was an absolute disaster, and equally for the entity, which was doing good work. We all probably have a leg of a goat down in Kenya somewhere at this point, or indeed a half a herd of them, or sheep. It was doing good work, and it was catastrophic for it. And the reputational risk for all those, and for the members on the board who didn't know what was going on, consequently, has reverberated throughout their career subsequently. So it is, and I mean, there's any amount of disasters out there. You know, there's a rolling kind of list of them, and particularly Anglo being the one that everyone leaps to mind. But even the AIB Bank, all the banks have had reputational risk issues and stuff like that on a rolling basis. Charities continually kind of coming up. And then, of course, you know, you had the big boy in the block, which escalated very quickly out of one particular issue in terms of Ryan Tubridy, morphed into a catastrophic reputational issue where they've actually now lost 40% of their income because people aren't paying their licenses. They're, you know, I think they're actually into a trading area of concern, which has been flagged at this point, that they are, you know, into kind of malfeasant trading as a consequence of that. And the people that are on the board, in fairness, you know, are in a very difficult situation. But the ARC, for example, there is a case, no one was asking any questions. And there was you know, I know there's 3 different corporate governance reports going on at the moment there, but it'll be interesting to see what comes out. But I suspect what happened was there was that kind of executive board, as they call themselves, were operating independent of the board, and the board just were nodding stuff through. So that you know, has had huge reverberations in terms of corporate governance. I would say, on a humorous aside, we have written to the Vatican ourselves, and we have asked that, you know, that we noted that there wasn't a saint dedicated for corporate governance. So we were going to ask, you know, for the Pope to consider that a few of those entity guides in the RTE could be potential canonized for that particular kind, because they've done more for the whole discipline of corporate governance than anyone else. And that brings us on to that legal and regulatory piece. I suppose just be aware of the freedom of information that I mentioned to you earlier. Okay. If you are dealing with entities that have state exposure insofar as state has shareholding in them, assure yourselves that you're not exposed to that. Lots and lots of people have come a cropper on this. And even if they're not on a straight FOI, you can be caught on the Airhouse Convention as well, which is the environmental one. And people have been caught on that one as well. So third parties regularly get caught on FOI. So just, I don't know what the situation is with banks specifically. I do know they have been caught through the Department of Finance and FOIs. So just be aware, that's all. Sustainability, when we talk about that, it's really about your own sustainability, not the global sustainability. You're all aware of ESG and the whole kind of sustainability metrics out there, and CSRD, which we just mentioned. But, you know, always be mindful of that you are a human entity. People ebb and flow, people get tired, get sick, they die, they retire. Just have that sustainability always in your mind. Be looking out kind of 24 months out, as I know you have, and I know Marita shared with me that you were kind of going through that discipline over the last while. But the fact that you've just done it doesn't mean that you should stop it. So it's that point about maybe that arc, have that little bit of nominations stitched into the terms of reference for it, that it's tasked with just looking out, you know, on a 24-month basis, who's coming to end of term, who's retiring, who's maybe doing this, that, and the other, or whatever. So just to be aware of that as well. On the plus side, the quality of governance cannot exceed those who govern. So, you know, the quality of the candidates that we see in Pinnacle seems to be quite strong. The fact that you're undertaking this exercise, and we will issue CPD certificates to you if you wish as well for your own documentation, happy to do that, is good. But I mean, it's all about the caliber of people. So I would say to you, keep your gunfighting skills reasonably high, keep yourselves abreast of information, read the papers, you know, keep a weather eye on what's going on in the media out there in corporate governance. It's regularly spoke about, but very few people actually take the time to do what you've done. And I know I've thrown a huge amount of information at you today, and hopefully one or two things stick. But it is that importance of education and kind of keeping your continual professional development education in the space. Maybe do a course once a year. And even what I would say is just do a parochial course on a subject matter of interest to you that's pertinent to the board in terms of, I would say, for example, AI governance is going to be a huge area coming forward. And it might be a competitive advantage for yourselves to actually look at that area and doing some training in that space. But that falls within the corporate governance regime. Just as I say off the top of my head as I'm thinking about that. As I said to Marita earlier, we were doing stuff in a separate house that we're involved in, and the numbers were absolutely astronomical in terms of what people, you know, the appetite for that area is huge at the moment. And again, you know, to that piece about sustainability, just have a clear succession plan put out on a piece of paper, a one-pager, have a succession plan in place, that business continuity piece that you're all very aware of, and so on. What we see, you know, we do board evaluations as our meat and veg. And what we're seeing is kind of the areas that are skills and expertise are no longer current. That actually speaks to cyber skills. That IT and cyber skills is a huge deficiency on boards. The perfect board nominee now would be someone who was from maybe the subcontinent or sub-Saharan Africa, was under 25, maybe female, had a PhD in cyber or AI. That would be just the perfect director. Maybe spoke a bit of Irish and Swahili. I mean, you'd be hitting all the sweet spots there at that point. I don't know if that person exists, but if they did, they could probably retire fairly soon with the quantum they'd be charging. And again, you know, people having skills that are highly skilled, but not relevant to the board in terms of your endeavor. So it's that gunfighting skill. It's all about skills. And again, the other kind of areas, people are kind of just feeling that they're not performing as a board. And what I mean by that is that they're not using their time efficiently. So that 2.5 hour window or 3 hour window, or whatever it is, just milk it, use it, be present, give it the attention. It might only happen 4, 5, 6 times a year, but when you're there, be there, give it the dedication, minute it, treat it as a thing, because ultimately the responsibility lies with yourselves. It's about kind of, you know, not being aware that under the law at the end, as I started, as I finish, that transparent piece, there are no derogations that you can give to yourselves in terms of accountability or responsibility. As the directors of Pinnacle, you are ultimately responsible for the entity under law, and there are no excuses, and ignorance is not a defense. So what you've done here today actually helps you in that regard to a degree, I hope. I want to say thank you for your time. And if you have any questions, I'll just come off sharing now.
Thanks for that, Pat. That's really good.
That was great. Yeah, it's scary, but it was great.